for green energy, right? So we can use the existing infrastructure for green energy, but we need to do everything to build renewable energy sources here in Germany.
So essentially, RW thinks it's a conservative strategy, but they are still also thinking that they are very well positioned when it comes to the competition, because obviously it's not the only player in the utilities market who is now pushing renewable energy. So essentially what Kreber was saying in another part of that interview as well, that he thinks that energy prices will actually go down again after a transformational period or phase in which the renewable capacities will be getting built up and the others are fading out. So I guess we're in for a couple of years even with potential turbulences on the energy markets, given what the utilities have to do and the industry needs to do. So I guess we're interesting time, and probably that's what Steve was saying early on as well. Inflation, if you look at the energy sector, is most likely here to stay.
Yeah, well, at least they'll have Nord Stream 2 to back up the German energy supply, Annetta, but that's another conversation perhaps for later on in the programme.
Not only about Germany, it's also about the UK.
Yeah, for sure. Yeah.
We're getting ours from Norway.
We're getting ours from Norway, are we?
Apparently, that's the...
Really? I thought we were just getting oil from wind.
From the Middle East as well. I think we've decided that we're going to have a...
Oh, aren't we getting a load of LNG tankers from Qatar or something?
That's right.
Yeah, I saw that story.
Yeah. Anyway.
Right, coming up on the show, oil rebounds after a weaker start to the week, but the energy transition is still in focus after COP26. We'll hear more from our crack team on the ground at the annual ADIPEC Forum after the break.
Good morning, everyone. This is Joe from New York Trading Room. I want to start with a few trades we did. We did the British pound. We are up 47 pips. If you remember, we did gold trade, British pound 2 days ago, short. Then we went long. So we went long because Morgan Stanley, when the UK data came better, he took longer positions. The other bank from Finland, he didn't go any short. Remember when we took short here, this bank from Sweden, he took the short. And then Morgan Stanley came here and he took long. So a lot of people ask if we can translate all this information to indicator, give us a buy signal and a sell signal without reading all the detail. So the programmer, he was okay finally to make this because a lot of people ask for it. And you can see we get the short here and we get the long here. Let me show you what Morgan Stanley said yesterday. You see, this is Morgan Stanley. Morgan Stanley research. He said it's going to be upside, and he was right actually, because you can see the British pound. As soon the data came better, the British pound started going higher. And we have a buy signal and we went long, and that's why we are 47 pips right now.
Welcome back, everybody. This is Squawk Box. These are your headlines. US President Joe Biden warns relations with China should not veer into conflict. holding his first official talks with President Xi, who called for win-win cooperation.
China and the US need to increase communication and cooperation, each run their domestic affairs well, and at the same time shoulder their share of international responsibilities.
The Dutch government reportedly launches a last-ditch attempt to keep Shell in the country after the oil major announces plans to shift its tax base to the UK and end its dual share structure. Tesla's market value dips below $1 trillion as CEO Elon Musk sells more shares, while JP Morgan sues the electric car maker for over $160 million, claiming breach of contract. The EU agrees to widen sanctions on Belarus in response to the escalating migrant crisis on its western border with Poland, while officials hold emergency talks to try and calm the rhetoric.
Nothing very committal on the US markets yesterday. We're just about 1% away from our record highs, though, despite all those inflationary concerns, which have taken treasuries to a mighty 1.6% yield, despite the fact that inflation is well over 5%. 6% handled last time round. October retail sales due today maybe shed more light on the economy in the fourth quarter. Asian indices look like this. We have the Hang Seng surging ahead, up 1.2%. The ASX 200 down 0.7%. Opening calls for European markets look like this. Again, pretty non-committal from the European markets. 73.43 on the FTSE. Xetra due to open at 16.127. Karen.
Steve, we're just looking at some corporate news flow and inflation again. One of the headline stories here, as IBM CEO Arvind Krishna says he's not worried about the long-term impact of inflation on the company's growth. He spoke to our colleague Dan on the sidelines of ADIPAC in Abu Dhabi and said he was confident that the company would be able to withstand temporary headwinds.
Geopolitics always comes into play, and I would turn around and say, but we have no control of that. So I'm going to go punt that on the side. First, let's acknowledge we still have a pandemic upon us. It's not yet an endemic. So I think if some weird new variant comes around, even worse than Delta, that would bother me. Because I think it'll cause a temporary, not a permanent slowdown. I have so much confidence. We have the correct protocols. We have vaccines. We can go fine-tune these vaccines. So I think that there is a way, but it could cause a temporary slowdown. Then with all of the liquidity and the fears of inflation raising its head, that can cause some chaos in this thing. Oh yeah, I don't think that's a 2022 threat. That's probably later than 2022.
You're not worried about inflation right now?
I'm always worried about it, but I'm not sure it'll have an impact on the business in 2022. So there's a subtle difference between the question was, what am I worried about the business? No, I am worried about inflation. That's why I raised the question. But I don't think it'll cause an impact on the business. But he also has a bird's eye view. I'm seeing more demand for technology than at any time during my career. I think that technology has kind of become the basis on which most companies and enterprises and governments do their thing. Take simple examples, like restaurants, stores would all have fought omni-channel even 2 years ago. Now, because of the pandemic, they all thought they needed to survive. But once they did it, they realized, wait, but that opens up my market. It's actually not more expensive, maybe cheaper to serve my clients this way. And suddenly this has opened up ways of doing things that people hadn't thought about. People in a certain demographic didn't want to do online. Everybody did online over the last 2 years. Countries like India leapfrogged onto e-delivery of everything. So to me, this has opened up an opportunity for technology, the likes of which we have not seen. I think Y2K may be a small approximation of what we're seeing. So I see tech spending heavy even through this environment.
Oil prices rebounding despite worries over rising COVID cases in Europe and concerns over the impact on growth prospects in the United States. President Biden is under pressure to release emergency oil reserves to cool skyrocketing gasoline prices. Well, they put Hadley in vision a little bit early, but there she is. And I'm going to carry on reading. Biden's response, as well as the future of the energy transition, are high on the agenda at this year's ADIPAC forum in Abu Dhabi. Guess who's there? Yeah, it's Hadley. Oh, what a surprise. Yeah, there you go. He joins on the ground. Hey, Hadley, you've been talking to a lady who I had a little bit of a run-in with before the US election. It didn't go that well, to be honest. But very interesting.
I heard about that.
Yeah, it didn't go too well. But very interesting to see what she's got to say about what the US options are going forward.
It was a fascinating conversation, Steve. She was part of a broader panel, as you know, about the energy transition and what's going to happen next. I asked her specifically about OPEC Plus and President Biden. I said, does it bother you that with an oil and gas industry at home that's essentially being slapped around in congressional committee, while at the same time being asked by the White House to produce more, that at the same point, the Biden administration is putting pressure on OPEC to increase production? And she said, listen, at the end of the day, it seems a little strange that he would be calling OPEC Plus members when he's got an industry right here at home. But I also asked her, of course, about the shale industry. What we know at this point is that oil production in the Permian, the largest oil field in the United States, is set to surpass pre-pandemic levels by December. One company, of course, operating very much in the Permian is, of course, Occidental. Listen in to what she had to say about U.S. shale.
What gave the shale industry a bad name were the companies that had a model of growth and growth only. And if you want to grow and only grow, and you're continually outspending your capital dollars are more than your cash coming in, you never make any income. And ultimately, the model doesn't work. The model has to fail at some point. We're not developing our shale in that way. We're developing it similar to the way we develop our conventional oil and gas. And that is, we're building infrastructure and facilities and maximizing net present value and getting the highest return on those assets. And those are quick return.
And, you know, it's a fascinating thing to sit back at one of these conferences and really watch who's coming through the door. I mean, we've got the energy ministers from Saudi Arabia, and of course the UAE's energy minister as well. Yesterday, walking the halls and talking about the energy transition. We heard from Dr. Sultan Al Jaber, the head of Abu Dhabi National Oil Company. He's also, of course, the UAE's envoy for climate change, essentially saying that the world has sleepwalked into an energy crunch and people need to wake up and get a reality check. Some really strong words from him. And at the same point, a huge Russia delegation. There was a UAE Russia joint session on strategy for climate and energy production, which I thought was very, very interesting. And really the only American presence was that CEO of Occidental. So a very different dynamic that we're seeing here, guys, than perhaps we've seen in the past.
It is very interesting. It's very interesting. I bumped into Dr. Sultan as well when I was in Glasgow. Not quite as warm.
He told me.
Yeah, he's a very nice man. He actually came up to me, one of the few people I didn't doorstep, actually. But a very nice man. But he did say I should get myself out to Abu Dhabi at some stage, you know, especially now the temperature's lovely again.
It is indeed, and we miss you out here, Steve.
You don't really. You're doing great work without me. I've seen some of Dan's work.
I do.
Oh, come on, Hadley. You two are nailing it. You don't need me.
I do.
Thank you for the words. I appreciate that. Well, we'll put you in vision for the next read, no doubt. Anyway, thank you. The Dutch... Oh, she's gone. Well done, Director Will. The Dutch government is reportedly scrambling to stop Shell from fully relocating headquarters to the UK. I should have thought that before, shouldn't they? The plan emerged after the oil giant revealed it is overhauling its structure to a single share system and moving its tax residency to the UK. According to the FT, the Dutch government wants to hold an 11th hour vote to scrap the country's dividend withholding tax, which has long been a source of complaint for Shell CEO Ben van Beurden. Well, what to say? This is a push-me-pull-you situation where Ben van Beurden has got two groups of investors. I said this with on Worldwide Exchange yesterday with Brian, actually. Very interesting. Fact is, he's under a lot of pressure to improve returns at the company and improve the price-earnings ratio at the company and have a transition at the same time. So you've got the transition lobby over here, those activists who forced him to The Hague for that court ruling early in the year. And you've got the third point chappies over there, ladies, who basically want more returns from the hydrocarbon industry, which is throwing off cash at the moment and perhaps not spending it all on the new technologies, which they say, if you split off into a separate unit, could achieve a much higher valuation, of course, as well. I wonder if it's just about scrambling to get those returns from hydrocarbon, personally, but I'm an old cynic. And here we are, Shell's trying to find some technical solutions to, at least in the short term, improve the share price performance and improve the buybacks, because obviously they're limited on buybacks at the moment because the RDS .A and .B, which is the London RIC code for their two listings as well, are a limited amount of buybacks you can have because of this structure in the Netherlands.
Well, I mean, the interesting thing is we've been here before, haven't we, with Unilever? And ultimately, you could argue that did for Paul Polman because he left shortly after the whole debacle with the fund management community in the UK about ultimately where Unilever was going to be structured for tax purposes. And the investors here said, sorry, we're not having it. We're not interested in that. We're going to sell your stock if you relocate domicile. And I think that the challenge for Shell in this case is, yes, they saw that story play out and they understand that the significant holders of Shell stock in fund management terms are all based in London.
Did you notice?
So they will get upset if they feel that the management are taking the wrong decision here. But it will be interesting to see what the Dutch government do at this point, whether they feel they have a card to play, because they described it, as we know, as an unpleasant surprise.
It's a small win-win for Shell. If they get the change of the withholding tax in the Netherlands and decide to keep with the dual structure, then win-win. I mean, the only thing like that, though, Karen, is once again, UK government minister going, oh, it's a win post-Brexit because it shows how good we are as a destination for foreign companies and capital as well. I'm not quite convinced it's about Brexit, but maybe I'm there to be convinced.
They've got to take the wins and the messaging around the wins if you can. But I think there's a broader message here about the type of jurisdiction you're going to have as you see this huge energy transition and the climate change targets. I mean, what's at stake here is that Shell doesn't have the flexibility that it needs. We all know what that game looks like as you start to transition away from what's been a very profitable industry to something that in the future is a hot area but may have smaller margins until you can scale up. What are you going to give shareholders? I mean, there's been this wonderful transition for investors where they've had a very strong energy price, so they've been able to benefit from that and using the share price performance as a result. When those energy prices cool off at some point, we know they don't remain sustained at high levels forever, then how do you compensate investors? And there's been a concern, I think, from Shell and from investors that if you don't have the ability to embark upon large share buybacks as a tool to keep those investors on board, then you may see those investors leave at some point, but energy prices move south. I think that flexibility is quite key for energy companies at this point. But there's messaging there too for other governments. We're not just talking about one company here that is part of this climate change transition. There are others too, and having a business-friendly jurisdiction for those companies to enable them to manage this transition is quite key. And I think, what we're seeing here, we've spoken about lobbyists for many, many years. This is a huge effort, isn't it? One company can change government policy here, and there was huge resistance to changing this withholding tax in the Netherlands. Shell might just be able to do the trick. The other point is it's not just this one regulation, is it? You have the Dutch courts being very unfriendly on those emissions targets. You've also had Dutch law be quite complex so in terms of takeovers. And we know at this point there's been a huge move to consolidate industry, trying to reshape portfolios for the future. And that goes to the heart of having regulation or having a system that allows these companies to clean up their backyard so they can reposition to be future-proof at this stage.
Let's move on. Karen, thank you very much indeed. Let's talk a little bit about Elon Musk. Elon Musk's share sale has continued into its second week. The billionaire has sold another $930 million in Tesla shares to cover tax obligations stemming from the exercise of stock options. Musk exercised options on Monday to buy over 2 million shares at $6.24 each, and now is required to pay income tax on the difference between the exercise price and the fair market value. Musk sold just under $7 billion worth last week. Meanwhile, Tesla is being sued by JP Morgan for more than $160 million. The bank is alleging a breach of contract over stock warrants, which expired this year, saying the warrants obliged Tesla to deliver shares or cash if its stock was worth more than the strike price at the time of expiry. JP Morgan repriced the options twice after Musk was sued for fraud by the SEC in 2018. Tesla is yet to comment.
Coming up on the show, COVID cases reach new records in some European countries, prompting concerns over fresh lockdowns. We'll bring you the latest on that after the break.
The black line, it's important level for a big order. So we usually, if we break the first black line, we're going to the second one. Like you can see, let me show you here. Like you can see, we're trading between the line. If we break here, we're going to this line. If we break down, we're going to this line. So it's just an important line. We keep our eye on it. Like if I am going higher with this black line and with this black line, this is a good area to short. And the same thing, if the market's coming down to this black line and this black line is good area to buy. So you can do this all day around. Now, we took first trade today was 627. This is the second one. Yeah, it's a very good trade. Yesterday also we did like 1 for 349, 395, 283, 48, 221, like 5-6 trade, and we lost 1 for 186.
To the latest around geopolitics in the region, and the Belarusian President Alexander Lukashenko has held a phone call with Germany's Angela Merkel amid the border crisis with EU member state Poland. This according to Belarusian state reporting, with no further details provided. The conversation marks the first contact between Lukashenko and a Western leader since 2020, when he ignited massive protests after claiming victory in a controversial presidential election. Meanwhile, Russian President Vladimir Putin and his French counterpart Emmanuel Macron have agreed the migrant crisis in Belarus must be de-escalated after a nearly 2-hour phone call yesterday. The two leaders did not agree on the origins of the situation, but Macron remains hopeful the conversation will, quote, yield results in the coming days. France also told Russia that NATO is prepared to defend Ukraine, where the alliance says the Kremlin has been building up troops. The US State Department has accused Minsk of creating the border crisis as a distraction to Russia's increasing military activity near Ukraine. The European Union will also ramp up sanctions against Belarus, targeting airlines as Poland reports nearly 4,000 people are trapped in freezing forests on the border.
COVID cases are hitting new highs across parts of Europe, with the Netherlands and Austria reinstating partial lockdowns. But some analysts argue each new wave of the virus causes fewer medical complications and less of a drag on economic performance. Well, let's look at it from an economic perspective. Holger Schmieding, chief economist at Berenberg. Well, first of all, Holger, very good morning to you. What is the situation in Germany at the moment?
Well, the situation in Germany where I'm sitting at the moment is case numbers are rising to new records. We also see that the number of people in hospital and intensive care units is also on the rise, but still far below the record levels we had seen there early this year. It's moving in the wrong direction, but it's not yet in any way a dire situation comparable to that we had in Germany.
Give us then the economist's interpretation of what it means for consumption patterns, Holger.
Well, the big difference is, of course, relative to earlier waves, that we do have vaccines. This now affects this part of the pandemic, mostly the unvaccinated. And the restrictions that are being imposed here and there, which are basically for Germany COVID passport rules, you have to show that you have been vaccinated or that you've recovered from the disease. These restrictions thus affect a falling number of people who also have a comparatively easy means to get around them, namely get vaccinated. And as a result, I think the impact on restaurants, on consumption of services will remain fairly limited, well below what it was in the previous winter.
Holger, as we look across Europe, though, we're starting to see some various different approaches. I mean, here in the UK, the mask is effectively been ripped off, and we're still letting this virus just circulate as we learn to live with it. And quite in contrast to the Netherlands, which only really came out of lockdown for a couple of months, has gone back into it. What do we make of that situation then? Because we saw in Asia a very different approach by the Chinese, almost zero tolerance around COVID. Do you think we start to see a very different approach in Europe over winter?
Yeah, I was trying to buy at this black line here, but I get bad feeling because the market jumped very quickly. So when I saw this, the market is going down. I cannot catch it buy. So the market jumped very quick, so I shorted. That's why you need to dance with the market up and down. You know what I mean? If you miss the buy, you can go short. If you miss the short, you wait for the run. Let's say the market is going higher and you miss the short here. It's not big end of the world, you know. You don't want to short down right here when the market starts going down, because your target will be here. So it's not good. I rather short if I miss the filling or the market jump very quick and I cannot get filled, so I wait for the next trade. So I usually wait until I get here. So I missed the buy right here for some reason. I didn't get filled. So when the market rallied to this line, I shorted. So I hope this is hi Reda. So we did the first trade with $600. You came late. Yesterday we did like 1100, 349, 365, 283, 48, 221, and we got one loss with 186. The day before we did 477 and 90. The day before 293. So we've been doing this every day for last year. Reda, JH, Reda is a big trader. This is the guy, he turned 7,000 to 2 million, 2.5 million in 2 weeks. So he's a big trader. I know him for a long time. So, and right now we took short early, and we have another one sell right now. All right, it's so far is a good day. Make our job easy. Sometimes the day is not going easy, but today so far is going good. So our target 1,000 a day. If we cannot make 1,000, we make like 500, 600, 700. This is our target. The job done. So we make our 1,000 for today. So 627 and 336. and everything will be recorded in case if the people is not there now. I want to explain something because a lot of people asking about how we trade this stuff using the grid. And before, I just want to give you update. So we talk about the bridge bound early when the Morgan Stanley took long in this area because the data was good. And the Swedish bank who took short early 3 days ago. So we got the short, we get 133 bips and 56 bips so far. So this is the idea from Morgan Stanley trade. And we did another trade also with good. In Euro Aussie. So the bridge bound is right now, it's 65 pips. Aussie franc, it's 14 pips. The third trade, we did good. I'll show you in 1 second now. We call Euro Aussie is 230 pips. I'll show you why on the chart. Just give me 1 second. Just try to find yeah, if we get Euro Aussie, this is like 230 pips, okay? We get the sell signal here, and the bank, he give like 3 target 1, 2, 3. Now, if you get a buy signal here, you don't take it because in order for you to take a long, you have to have a blue and the blue line. And you stay on the trade until you see red and red. So we got in Euro Aussie 2 days ago. And this was a recommendation from one bank. I just want to get you the screenshot. We need to find out which bank is it. But anyway, so right now the bank, he covered his short and he was going long now, and his target is right here, second target and third target. Okay, so I have so many screens, so I need to move between the screen to get you the screenshot. Now also we have a big option I posted yesterday for euro dollar and yeah, Aussie franc also with another trade from the bank, 53 pips. Yeah, this is when the bank he went short in EuroCAD. You see, he made 238. So Euro Aussie, EuroCAD also. Let me show you EuroCAD. You can see the same thing. EuroCAD, he took short from here. So remember, EuroCAD, he's up 238 pips because it was a good sell signal. So the indicator he give him, like from here, in this area, you ignore the buy signal, okay? So you must have a match, red with red, and blue with blue, in order for you to go long or short, okay? So this was a second trade, what was a good bank, and he did it. Now, for the grid, let me show you something here. It's very easy. When we use the grid, if you have a green boxes, it's a buy. So usually you put a buy order here, your target here or here, okay? It's around 20 pips. Your stop loss will be behind those square boxes, the green boxes. And this is the three scenario, even green or red boxes, this is a sell order, and your target here and here. And if you see green boxes and red boxes, this is no trades. This is the only three scenario you will face. It's a buy or sell or no trade. The market can go only three way. Going higher, going lower, or sideways. For gold trade, in case if you don't know how we trade the gold trade, like our target 15,000 every month, and if you look from the beginning of the month, we did 10,000 right now. Today is 1016, because someday we make 1,000, someday we do like 500, 600, 700. If I do 3 months, you will see it's about 45,000. Then look at the gold trade. So you need to watch this line now, because if we break this line, we're going to this line. We can take a big swing short, but we need to see this line. We need to watch it.
Because at least that will keep some interest in the share price.
Isn't it amazing when there's inflation fears left, right and centre, but we're all getting fantastic deals on our mobile phone contracts still. I want to move on, if I may. It's a conversation that obviously Karen will lead next time we come back to it as well, because she's got so much knowledge from all those amazing mobile conferences she goes to. But so look, this is interesting. We're talking about Andrew Bailey, and I've already kind of fired a broadside today about that 7-2 vote that the Bank of England had last time round that left everyone a little bit confused because we've all been prepped for a rate hike as well. Well, he cited apparently in the last 24 hours the fact that they're worried about the furlough scheme ending as well. And rightly so. You know, it's one of the factors they have to consider. But UK employment figures, earnings figures, we're just seeing now a lot of UK data coming out. UK average weekly earnings up 5.8% year on year in the last 3 months. 5.8% increase. I thought when it went into the employment market, I thought that was when inflation became entrenched. Have I mucked up my economic
only when it becomes a wage price spiral, I think it's embedded
let's take out the
inflation
bonuses. Let's take out the bonuses for rich people like you in the city who earn massive Do you earn a bonus? No. Okay. No. But UK average weekly earnings ex bonus. So that's us normal people, yeah? Although I don't know about 4.9% increase year on year. That sounds quite toppy, doesn't it? Is that above 2%? Is 4.9 higher than 2?
What is the
just because 2% is inflation target, yeah?
But did I see a couple of days ago the vacancy rate's now 2 million jobs?
Transitory.
Right.
It's transitory.
Right.
Did you see the Schultz data at the tail end of last week?
Yes.
Transitory.
Yes.
All those quits.
Yes.
Transitory.
Yes, but there was some data, I think, out of one of the Federal Reserve banks, maybe Atlanta, showing how much of an increase in salary you could get if you just shifted employers. So we talked a lot about the Great Resignation. It seems that the Great Resignation has largely been about resigning and then re-signing with another company because you can get immediately a 4 to 5% increase.
Is that right?
Yeah. So the survey data just confirms actually that people are behaving very rationally because they see the opportunity to move to a different business sector.
Do you think it's good long? How you feel about this long? I mean, can you go long here? I have a feeling I just need to watch it. So the question is, can you go long here? Well, when you have experience, you will get the feeling it's gonna hold or not. My feeling is not holding, But if you wanna go long right here for quick, if it go against you, you can buy another one right here in this area. But I have a feeling this will not hold. And we will go test this line. Because this candle here, it went very quickly. So a lot of buyer around this area. Now we started breaking this line, The buyer never show up right here. So I have a feeling this will be break. And we will touch this line. You don't have to be in London. Maybe we'll touch this line in US or this line. You see? I have the feeling, you can tell if the market is going to react good or bad. You see? Are you long, JH? See, it's let's see if this line is gonna hold or not. Like my target in this account, like 1,000 a day, 500, and I did my target. Maybe trade Forex. Not gold. My gold trade is done for this account now.
First direct talks between the superpowers since the administration took office. The virtual summit lasted just under 2 hours, and it saw both heads of state call for cooperation and the implementation of measures to avoid conflict. Sam, beyond the fact that they actually spoke, how encouraged should we all be about a meeting of minds here between the United States and China on some of these key flashpoints?
Yeah, very good question, Jeff. I mean, combing through the commentary from both the US and China over the last few hours, as expected, there were no sort of major breakthroughs. So really, at the very least, this was a sign of continued engagement between the two sides, certainly at a top level, as evidently at a lower level, they've really not got anywhere. But the big question will be, what happens next? Will there be any sort of follow through from this meeting? From that, you can probably guess there will be, because, you know, Xi Jinping called Biden his old friend. Biden, on the other hand, said that he hoped to meet President Xi Jinping in person, in face-to-face. So the opening pleasantry certainly suggests that there is a desire now for continued engagement between the two sides. But really, when they got down to brass tacks, they did cover a lot of ground, as expected. They spoke about Taiwan. President Xi Jinping sent a bit of a warning to the US, saying that China will take decisive measures if Taiwan independence forces cross that red line, which, of course, we've heard a number of times coming from Beijing. Biden, on the other hand, said that the US would stay committed to that one China policy, but also said that they were at odds with Beijing's behaviour in the Taiwan Strait. Again, it will be the actions that speak volumes, because the big question now is whether that will see a dialing back of this military activity on Beijing's part around the Taiwan Strait, which we know is very much an expression of frustration over these increasing US-Taiwan ties. They also touched on things like human rights. They talked about Hong Kong and also Xinjiang. They also touched on trade. But as I say, as expected, guys, no major breakthroughs. But as I say, we'll be watching to see what happens next and what that follow through may look like.
Sam, terrific. Thank you so much for that. Let's get to Stephen Isaacs then, Chairman of the Investment Committee of Alvine Capital. Stephen, good morning. Can I ask you, one of the key questions, I think, for markets at the moment is, how much does it matter if there is a change at the helm of the Federal Reserve here? And we are being told by the Wall Street Journal that President Biden is likely to make a decision this week. Do personalities matter in this case, or will it be a continuation of the same theme around inflation, even if we see Jay Powell go?
Well, monetary policy is the be-all and end-all. I mean, it has been added recently by fiscal policy, but at the end of the day, I think we all know that markets wouldn't be here if it wasn't for this incredible experiment in both zero or negative interest rates and continued QE. So who sits there and the mandate they have are incredibly important. I would ask all investors to focus very, very much on this. The question of the choice, I mean, this is a late choice. I mean, traditionally, presidents who do have the power, although obviously it has to be confirmed by the Senate, but that's very rare to be turned down. Presidents are tended to choose somebody in the early autumn, sometimes straight after Labor Day. So here we are coming up to Thanksgiving with this issue being left rather late in the day. And I think now
this line so far holding, but we have a problem. Now going higher, this black line, we need to stay above this black line so we can reach this line. If we cannot hold above this line, we're going to this line. Now, Reda, are you in any trade right now, or are you still watching? Let me see your trade, if you have a trade. Let me find out. Guys, if you wanna follow Reda, You have account here. You can watch his trade. He just started his trade in MQ5 and MQL4. This is a guy, he turned $7,000 to $2.5 million in 2 weeks. So you guys remember Euro Yen? It was I guess he took this trade here in Euro Yen a year ago. 2020. When the market went down from 2020, it was going down. Let me show you on this. You have more data. Like Euro Yen. If you look at the daily for 3 years, yeah, when the market on 20, when the market went down big on Corona, he took Euro Yen. So if you want to follow him, here is the link. I can post it. On the chat. And I guess he have another one, MQ4. This is MQ5 and MQ4. I guess he already on trade and he made one trade. He have a trade was $15. I don't know which one is it. So it's good to share the information. So a lot of traders, maybe they have a good trading system. You can share with us what you do. We don't have any problem to share it. Okay. I want to see the gold trade. What is the gold trade here? Like it's a mixed signal so far. Let's wait and see for a few minutes. Maybe I'm planning to trade the Forex market. On the grid is better. Like Euro Aussie, I like Euro Aussie sell.
Management. Credit Suisse analysts have picked a raft of high-margin stocks they believe could safely navigate a high inflation environment. The full list on our premium service, CNBC Pro. Take a look at those on the website. We'll bring you Aneta's interview with RWE CEO Markus Kreber as the German utilities group unveils a 50 billion euro investment drive to become net zero. But question marks hang over supply bottlenecks and its coal-fired power plants. We'll be right back.
So bound Aussie is very strong, and Aussie dollar is very weak. So you take bound Aussie long, and you can see or bound New Zealand or bound yen. So bound Aussie long, bound yen long, bound New Zealand long. Okay, you can pick, you don't have to take the three.
The Dutch government is reportedly scrambling to stop Shell from fully relocating its headquarters to the United Kingdom. The plan emerged after the oil giant revealed it is overhauling its structure to a single share system and moving its tax residency to the UK. According to the Financial Times, the Dutch government wants to hold an 11th hour vote to scrap the country's dividend tax, which has long been a source of complaint for Shell CEO Ben van Beurden.
It looks like the quote is short.
Elsewhere, Arva Air has unveiled a €50 billion investment
I guess we're
driving
just
to
going to
green
target
energy
this black
as it
line.
aims to reach net zero emissions. The German utility group says it plans to finance the transition from its own cash flows, with the bulk of investment going into solar, wind power and batteries. So let's get out to Annette for more. Annette, let's just talk about the direction for the company from here, because the stock price had the initial bounce back after the pandemic, but then it's been pretty much a sideways trade. So how dramatically will this change the company's fortunes, and what do you think the investor response is going to be?
Actually, if you look at what analysts are saying about RWE, it's surprisingly optimistic for their outlook. I think the stock market this year has been quite, sort of waiting for what RWE is planning to do in order to tackle the future. But now their transformational plan is here. And what they are doing is pretty much in line with their competition is doing as well. So they're putting a lot of money at play in the renewable space, but it's with a special focus also on hydrogen. Hydrogen is very much in demand from big industrial companies, because you can't power for example, a steel production process with electric energy. You need to have hydrogen. And the same holds true also for a lot of the chemical industry. So hydrogen is at the core of the decarbonization of the German but also other industries. It's not a German speciality. So essentially what we're hearing now from RWE is that they have enough cash flow to finance these 50 billion euros investment scheme, and that they're also willing to partner up with specific projects with others in order to get the feet on the ground. But of course, the key question is whether they can be as profitable as with fossil fuel, and that's what I had to ask.
Maybe go short if this line doesn't hold. Maybe go short if this line doesn't hold on gold, and our target will be this black line.
The solar plant is definitely less risky than offshore wind. And when we go to the next level, floating offshore wind, they are even more risky because it's not a proven technology. And what we try to do to have a portfolio of different technologies, but then always a risk-adjusted return so that we create the same value depending on the different risk and technologies. But I'm actually not concerned about the profitability of our business, because as you say, there is significant demand for green energy. And so everybody who is able to provide green energy will in the end sit in a growth market.
What are you telling investors? Why should they buy into your stock?
I mean, when you see what we have announced today, it's a significant growth and investment program into the green energy world. 50 billion. We are adding significant capacity. We show a very good track record in our earnings. We expect 9% growth in our core earnings, and that will lead to 5 billion EBITDA in 2030. And besides that, we are the driving force behind the green energy world. We have all the capabilities in-house. We can produce green electricity from wind and solar. We can provide storage solutions, flexible generation solution. We are an active driver of the hydrogen economy and perfectly located to also provide the industries with the need and solutions they have.
Of course, just after 2 weeks plus negotiations in Glasgow, I had to ask him as well what he thinks is the outcome, or whether the outcome is actually positive, or whether it should have been more.
You can always wish for more. What is very important is that climate diplomacy is now taking one step in the right direction. And there is more or less global alignment that needs to be tackled. And I think it's totally natural that you have different interests for the developing world and the industrialized world. So I think there is a lot of positive. But I think we need to continue now. We need to find a level playing field for industries, because when we allow green products need to be competitive with non-green products, that could end up easily in trade wars and things like that, and that needs to be avoided. So I think the global alignment is very important. COP26 has taken a step in the right direction, but we need more.
In another part of that interview, but he also made pretty clear that a country like Germany for now can't rely on renewables. There is also a big need for gas-powered power plants, because otherwise energy security could actually be endangered with big industrials just needing a lot of energy also going forward.
Excellent work, as ever, Annetta. Thank you very much indeed. Well, look, the European markets, there's a tiny smattering of green, but quite frankly, it's all a bit piecemeal at the moment. We have US retail sales a little bit later on today for October, so that might dictate the destiny of these markets a bit more. CAC futures, though, the best of the bunch, up 0.3%.
So far, I guess we're gonna hit this target in gold. This line never hold. Now bound Aussie. Bound is very strong against the Aussie, and bound New Zealand also is very strong. Now I need to find out what is the important level, so I'll draw it on the chart. Give me 1 minute. So I need to find out what is the black line on this chart. Or you can use the we are 189. So what you can do, you can just so let me do this. Bound OC for bound OC. You can see green, green, green. So any dip you just buy. And bound New Zealand. And bound yen. Okay.
Welcome back to Scorebox. These are your headlines. Inflation concerns looming large in the UK, with average weekly earnings rising by nearly 6% in the quarter, whilst vacancies hit an all-time high. Vodafone hikes its full-year earnings guidance range as well as its free cash flow target on the back of strong growth in its key market, Germany. Well, it was just over 1%, to be fair. The Dutch government reportedly launching a last-ditch attempt to keep Shell in the country after the oil major announces plans to shift its tax base to the UK and end its dual share structure. Plus, US President Joe Biden warns relations with China should not veer into conflict, holding his first official talks with President Xi Jinping, who calls for win-win cooperation.
China and the US need to increase communication and cooperation, each run their domestic affairs well and, at the same time, shoulder their share of international responsibilities.
I'm still taken aback by my headline and what, but since when did 1% growth at a telecom company represent good revenue growth? Shows how far we've come, doesn't it? I remember when double digit was good revenue growth at these companies at the turn of the century.
Like I said earlier, bound OC is very strong. Bound New Zealand, very strong. And bound yen. That's why I have this rechart, and we be focused on the pullback. Any pullback, we need to go long. You can take all the three, or you just take one. It depends what size is your account. But this is the strong pair you can see right now, and this is the weak pair. So we take the strong against the weak. If you look at the candle on the daily, bound OC, bound New Zealandese, we have very strong candle now. So give me a few minutes. I need to draw the black line here. So we need to watch. And in the meantime, let's watch the like you see this line never hold for the upside. So I guess we're just gonna test this line and maybe in end of London or maybe US session, maybe this line and this line, it looks like. So let's take it step by step. We watch this line. If it didn't work, this is our target here. So we need to rally. I'm planning to take a short, and my target is here. But let's watch if this line is going to hold or not. Because in gold, you can see, you can play this up and down. You see, when you have a green and red, the market, you need to sell the rally, you buy the pullback. Sell the rally, buy the pullback. So when you have a green, you just buy only the dip. Okay? Like this one is sideways. This is the sell, so you need to sell the rally. Here is green, you need to buy only, buy only, buy only. You see? Everything is very clear. You don't want to buy at the top. You wanna wait for the pullback, like 3 green red candle, then you buy. Like you see this is the pullback. As soon as you see green candle, you buy long. As soon as you see green candle, after 3 red candle, you go long. Now you wait until the market pullback. When you see green candle start going higher, you can jump. Even if you bought here and the market go back a little bit, you need to buy again because we are very strong. The only way you exit your trade if this turn red like this. You have to get out. But as long as this is green, you are okay.
For the service I asked for. There are enormous pressures out there at the moment, aren't there? We must be seeing it across the board.
Yeah, I think what's really exciting about Checkatrade is that we've extended our market leadership through COVID. So 84% of homeowners know the Checkatrade name and jingle. We have 20% share of the market now. It is
for the service I asked for.
There are trades out there are busy. That's been a bit of a headwind in signing up new trades. But the good news is that the COVID peak in work is slowing down a bit. We are seeing that our Checkatrade trades do have some slots in the diary, and we are successfully signing up additional trades. We've seen growth of 1,000 new trades signing up over the course of the last 6 weeks. And really importantly, we've launched a £3,000 guarantee for consumers. That's national, and that's really helping more loyalty, customers to come back to Checkatrade. If they haven't found a trade that's available, then go back online and find another one. This is one of the few online marketplaces that is happening, but hasn't fully happened in the way that travel and hospitality have happened. So it's really, really exciting. We saw our Home Experts division, which includes eLocal in America, Habitissimo in Spain, Portugal and Italy, moved into profitability for the first time in this first half to the tune of £3.7 million, and that was compared with a loss of £4.4 million in the first half of last year. So all looking very encouraging.
Richard, do we have labour shortages in the United Kingdom?
We do. If you look longer term, then we require 1.25 million more people to come into the construction sector by 2030. So the long-term solution to that is more and more apprentices. We have a target of creating 25,000 new apprentices over the next 3 years in HomeServe and across our Checkatrade trades. I do also think there's a big opportunity in reskilling. If you take a more mature person that's maybe made redundant from retail, they're a ex-army person, and they're good with their hands, and they'd like to retrain as a plumber, heating engineer, electrician, plasterer. There are training organisations out there that can retrain these people in 12 months. And that's really important that we get on and do that. We get that message across to people looking to move into a really attractive sector. There's a lot of money to be made. If you're a self-employed plumber or heating engineer or electrician, lots of work out there. So my message is get on and retrain, get your MVQ2 within 12 months and sign up for your Checkatrade membership.
Richard, I want to take the conversation a slightly different angle and ask you about the greening of the economy, because Boris Johnson wants to ban the sale of gas boilers by 2035. We are still seeing these huge conversations take place at a corporate and country level around heating emissions targets. But where is the consumer in this journey? Are you seeing decisions made at this?
Now, if you miss, this is, I guess, you can see. Never hold. Okay, now let's watch if this line is gonna hold or no, because if hold, he cannot go above this line. We're going to this line, so let's watch it. You see bound yen, we have a clear road. How about we just, yeah, you see bound yen is going higher. As soon as we clear this 63.70, we're going higher. We can jump very quickly to 63.
We're retraining our engineers and our HVAC businesses to put that equipment in. But we need to take that government funding and bridge the gap with external commercial consumer finance at affordable interest rates and enabling homeowners to spread those payments over 10 or 15-year life of the equipment.
Richard, thank you very much for joining us today. Richard Harper with us, founder and CEO of HomeServe. Let's talk about what's happening at the geopolitical level across Europe as Belarusian President Alexander Lukashenko has held a phone call with Germany's Angela Merkel amid the border crisis with EU member state Poland. This according to Belarusian state reporting with no further details provided. The conversation marks the first contact between Lukashenko and a Western leader since 2020, when he ignited massive protests after claiming victory in a controversial presidential election. Meanwhile, Russian President Vladimir Putin and his French counterpart Emmanuel Macron have agreed the migrant crisis in Belarus must be de-escalated after a nearly two-hour phone call yesterday. Now, the two leaders did not agree on the origins of the situation, but Macron remains hopeful the conversation will, quote, yield results in the coming days. Well, France has also told Russia that NATO is prepared to defend Ukraine, where the alliance says the Kremlin has been building up troops. The US State Department has accused Minsk of creating the border crisis as a distraction to Russia's increasing military activity in the Ukraine. The European Union will also ramp up sanctions against Belarus, targeting airlines, as Poland reports nearly 4,000 people are trapped in freezing forests on the border.
Right, coming up on the show, Landsec returns to profit. We'll discuss that with the CEO, Mark Allen, coming up on Scorebox. Elon Musk's share sale has continued into its second week. The billionaire has sold another $930 million in Tesla shares to cover tax obligations stemming from the exercise of stock options. Mr. Musk had exercise options on Monday to buy over 2 million shares at $6.24 each. Really? Wow. And so is required to pay income tax on the difference between the exercise price and the fair market value. Musk sold just under $7 billion worth of stock last week. Meanwhile, Tesla is being sued by JP Morgan for more than $160 million. The bank is alleging a breach of contract over stock warrants, which expired this year, saying the warrants obliged Tesla to deliver shares or cash if the stock was worth more than the strike price at the time of expiry. JP Morgan repriced the options twice after Musk was sued for fraud by the SEC in 2018. Tesla is yet to comment.
It's another busy day on the earnings front, and Landsec is also on our radar today, which has returned to profit with half-yearly pre-tax earnings of £275 million. The UK's largest commercial property firm said rents for prime London offices remained resilient despite the pandemic. Joining us now is Mark Allen, the CEO of Landsec. Mark, you've got a fairly large central London portfolio. And when you look across some of the trends now, it's clearly much busier across in the central parts of London than what it has been. Some days busier than others, including a Thursday. What trends are you witnessing, and what is that doing in terms of the leasing side of the portfolio?
Good morning. Yes, as a business, Landsec has three focus areas. Central London is the largest. We also focus on major retail destinations and also mixed-use urban areas. But in central London, certainly since September, we've seen a marked increase in returns to the centre of town. Anyone who's tried to make a restaurant booking over the past couple of months, I think will testify to just how busy central London is. But we're really seeing a strong and sustained return to the office. We're at around, in the middle of the week now, probably around 2/3 of pre-COVID levels. So really quite a strong bounce. And what that's meaning is that occupiers, employers are more confident now in making decisions about the space that they want to lease. And those were decisions that were being put off over the past 18 or so months. So if you look across the London office market as a whole, the amount of space that's now under offer to occupiers that'll be leasing that over the next 3 to 6 months is now back above where it's been on average over the past 10 years. And in our own portfolio, we've seen a lot of activity. I've spoken to a lot of our occupiers, and what they're asking is not how much space they need, but how do they need to use that space to be able to make sure they can attract the right calibre of staff and retain the right calibre of staff for them to be competitive in the long term.
Can I ask you about the competition? Because I was talking to an executive recently who was calling out some of the new models that have come to the market and how useful they are, because they're quite flexible when you're taking office space across a number of different countries. For instance, if you're not using enough space in one country, you can use some of the credits and the money that you would have spent and put it in another country where you might want to bulk up. How flexible are your models, and are you seeing a lot of competition in this space from rivals trying to offer up the right leasing model for some of their office customers?
Yeah, there are three things I think that we hear consistently back from our office customers that's really important to them with regards to their space. One is quality. The third is and I think this is a sector that has seen quite a lot of innovation in that space over the last 5 or so years, but I think it's also right to see quite a lot more. So having access to flexible space, I mean, we have a small but pretty rapidly growing flexible office products of our own called Myo. What we're finding in some of our office locations in the centre of London is we've got occupiers that will take multiple floors from us ourselves, but they also want access to our flexible products so that they can scale up and scale back depending on their demands, whether that's special projects, whether it's conferences, large meetings, whatever it may be. So I think flexibility is definitely here to stay. And for a business like Landsec to be successful for the long term, we need to be able to respond to those customer needs. So quality, sustainability and flexibility are the three watchwords of those customer needs. And I think we as a business feel really well placed to respond to those.
Mark, good morning to you. Right old mouthful here. The EPRA, net tangible assets per share, up 2.7% to 1012. Your share price is trading at 710. Why doesn't the market believe you on your EPRA, net tangible assets?
Yeah, we do like a good acronym in the real estate sector. So our net assets per share, effectively, as you say, £10.12 up over the 6 months. Stock trading at about a 30% discount to that. Our business has got three focus areas. The two largest, though, office and retail, have been sectors that have been pretty challenging over the last 5 or so years. We've had Brexit uncertainty hitting London. We've had structural changes, online retail hitting physical retail. And then, of course, we had a pandemic on top of it. So the market's looking at what returns can they expect to receive from those sectors. And the outlook has been pretty uncertain. I think what we've shown with the 6-month period is actually just the resilience of those two parts of the business in particular. And I think you'll find now with the market looking at, okay, rents in retail are now growing. Vacancy in retail is down. Central London rents are starting to grow again. Occupancy in offices is all still very robust. Those are all things I think the market has been pretty anxious about. I think what our results show today is that anxiety should be subsiding and people should be able to focus with more confidence on the drivers of growth that we've got as a business ahead of us.
Mark, the sector's classically very interest rate sensitive, and we have a Bank of England governor now who is under immense pressure to take action to tackle this spike in inflation. How do you think Landsec would do if we begin to see a progressive stage of interest rate hikes now?
Yeah, I mean, as you say, inflation, interest rate risk is obviously something that's very relevant for a real estate business that owns a lot of assets where the value is driven by the yield investors can get on their rent. But what we've had over the last 5+ years, London in particular, has been a very big premium. So the yield that you can get on a London office will be 4% or so compared to a base rate that's barely over zero. So there's been a very large gap between those two things for a very long period of time. And that's been at abnormally high levels for the last 5 or so years. So I think certainly the market is already pricing in an element of interest rate rises from here. Certainly the longer end of the yield curve has been tracking upwards. But despite that, we're seeing yields come down on London offices in particular because of the sheer weight of capital that is around globally, how London looks on a relative basis to other global cities around the world. It's still looking relatively inexpensive. So I think there's quite a bit of room for those rates to grow before there's any pressure on the valuations. And if I look at the retail side, that's consumer spending. Our rents are linked to retailer turnover. So wage inflation should translate into that consumer spending.
Good to see you, Mark. Appreciate your time. Thank you very much indeed for taking our questions today. Mark Allen, CEO on Landsec. Well, how they open, we'll have a look at in a couple of minutes' time.
pound yen is very strong. I mean, we clear 163.7 and now we going to 153.87, 198. So it's very strong. We have a clear road on pound yen.
Let's have a look at these European indices, which are opening slightly better, actually, than the flattish calls that we were given in the pre-market and that the futures were trading at. So we're 0.2% higher, with around about 50% of stocks already opening their doors to business so far today. Very interesting snapshots we've had from the likes of RVA, from the likes of HomeServe, and we just heard there from Land Securities as well. I thought that was fascinating, and I thought it was a very interesting conversation with the CEO there. Not least the fact that Jeff and I were pointing out to him that your net asset value, as it used to be called, or your EPRA value of net tangible assets, is about is trading at about 1,000 pence. But the market's saying you're worth 700 pence. So big disconnect there, isn't there, in terms of the valuations? Maybe there's an opportunity there, but maybe that traditional discount that we see in that sector, maybe that will continue. Again, 0.3% higher. Let's have a look at some sectors. 6 out of 10 sectors were in positive territory in the States yesterday, led by utilities, actually. Not very exciting, 1.3% higher for those. Today, every single sector is either flat or in positive territory, led by, well, what a pairing, retail and telcos and oil and gas as well. As we said pre-market, Vodafone mounting a bit of a rally. I mean, again, what has happened where a 1.2% increase in German revenues counts as good? There was a time when you think it's nowhere near to justify the kind of investment in technology that this company is putting in. But we're coming off a low base, aren't we? BT, I noticed, 166. Nokia up 0.6%. Oil and gas sector responding, I guess, to multiple factors. One on the corporate level, Royal Dutch Shell trading just shy of £20 sterling. Of course, perhaps a win-win now created by Ben van Beurden's group, i.e. if they stay with the dual-listed structure, then they get concessions on the withholding tax in the Netherlands. If they carry on moving to the UK, then shareholders will be excited about the prospect of more buybacks. And of course, the other factor on a more macro level, the oil price is trading around about $1 higher than it was 24 hours earlier. In terms of the retail sector, Zalando and Hennes & Mauritz, two of the stocks in positive territory. European bourses, well, is the German market ahead of the rest? It was in pre-market. No. Actually, the CAC trading up 0.4%. I just had young Michael in the gallery shouting out across to me, DAX record high. So there you go, 16,181, up 32 points. Elsewhere, we have gains across the board, apart from in Switzerland, where I note, like in the rest of Europe, they are concerned now about the rising COVID cases. So, as I just mentioned, the Dutch government is reportedly scrambling to stop Shell from fully relocating its headquarters to the United Kingdom. The plan emerged after the oil giant revealed it is overhauling its complicated structure to a single share system. Anyone who's ever traded this stock, RDSB and RDSA.L on the REC, it's always been a slightly confusing scenario. But the Dutch aims now to try and stop them from moving sole residency to the UK. Now, according to the Financial Times, the Dutch government wants to hold an 11th hour vote to scrap the country's withholding dividend tax, which has long been a source of complaint for not only the Shell CEO, Ben van Beurden, but also for those voracious shareholders who want extra buybacks from the company. Okay, so let's take a look at this. Vodafone is rallying today, although, again, I hasten to add, it is still trading below 50% of what it was trading at its highs in the last 5 years. 117.46, up 4.4%. So they've basically hiked their free cash flow guidance after posting adjusted core earnings growth of 6.5% in the first half of the fiscal year. The European telco group pointed to Germany as its growth driver. Again, fascinating. Nick Reed is the CEO, said the group is on pace to meet its guidance for the year, as well as its medium-term financial targets. But a good day for Vodafone, no doubt about it. And I'll just show you the last 12 months. Again, you know, they've had a peak at around about 145, 150, got down to 106 quite recently, now 10 pence above that low. Elsewhere, Bouygues profit swung back to pre-pandemic levels in the third quarter, topping estimates at 1.14 billion euros. The French industrial giant says that performance at its broadcast business, as well as its construction arm. Again, these days, when you're talking about the split of GE, a company that has a broadcast and construction arm, it's a real head scratcher for those financial consultants out there who would love to split it up, isn't it? Anyway, it helped drive margins higher. The group confirmed its outlook for 2021 as it prepares for a slew.
This is a good lesson here. We trade the gold in first hour in London because it's easy to find out when it's going higher, you short, and when it go down, you buy. After first hour, it's very hard. It's going to be very tricky. You go up and down, you break the line, you go under the line, you know what I mean? Like here, the first hour of London, yeah, respect, but after that, it can be up and down, up and down. That's why I don't like. If you want to trade the big picture, let it go to the black line and you short. Let it go to the black line and you buy. But right here in this area now, it's, to be honest, I feel it's short, okay? And we're gonna hit this line in New York or maybe next couple hours. If you went short here and the market went to this line, you can add another short here. So when the market come back, you will make money on this and this will break even. But I have a feel. That's why I said I'm trading the first hour in London because I know this is going to happen. It's going to go down, go up, and you never know it's going to go up or down after that during the day. I hope this is clear, GH. You know why I stopped trading after the first hour in gold account.
It's 20%.
It's 19.7%. That is absolutely extraordinary. Now, I don't go to pubs too often these days, unfortunately. I don't get out as much as I used to, but isn't that extraordinary? 20% higher. I'm sure it's just transitory, but yeah, I'll go into a bit more detail. In London, the price of a pint, which was always more expensive, is up 10.2%. The price of a pint in Liverpool, you're in trouble. That's 20% in Liverpool as well. What else have I got for you? Belfast, 9%. Stout. Do you drink stout? We drink like stout occasionally, don't we?
Occasionally.
I think that's Guinness, isn't it? Stout?
Yes, yeah.
Or Nuki Brown Ale. Up 7.29%. I just thought that was extraordinary because I've got this Diageo. I tell you the problem is the person who's really suffering is Karen because she likes a pint in London as well, doesn't she? Or a pint of wine, I should say. Anyway, Karen, have you noticed the price is going up? I mean, on your Petrus?
Would you believe I haven't noticed a pint rising? But I think the wine or category.
And that's why I switched from gold to Bownian and bound Aussie, bound New Zealand, because the Forex market now you can see, so it's easy to trade the Forex after 1 hour from London. So you need to know which pair you need to trade the right time, you know what I mean? You take the best hour on gold and first hour in London, then you go back to the currency and you dance with it, you know what I mean? And you can see it's very strong. The Bownian is very strong. You can see here, it's bound strong against the Aussie, bound yen, bound New Zealand. Bound New Zealand, it's much better.
confused. Let's move on. This is just transitory as well. Average weekly earnings rose by nearly 6% on the year in the 3 months to September, well ahead of expectations. 6%, just transitory, I'm sure, as inflation worries show little sign of receding. Meanwhile, vacancies hit an all-time high of 1.17 million in the 3 months to October. Just one more thing on vacancies, yeah? We just had, what do we have, Jeff? Richard Halpin, the CEO of HomeServe. How many engineers, plumbers, electricians, decorators did he say we're missing over the next couple of years? He said 1.25 million.
1.25 million.
1.25 million.
Yeah.
Just transitory, I'm told, Karen. Just transitory.
Let's get some thoughts with Sebastian Radler, who joins us now, Head of European Equity Strategy at Bank of America Merrill Lynch. Sebastian, thank you very much for joining us. So we've seen a high water mark on some of these stock markets day after day. The German stock market at records, the French market, it's almost a one-way trade since the start of October on some of these big stock markets. But you're now calling a correction into next year, what, 10% to expect to come off these major markets. What's the catalyst for that sell-off?
Very simple terms, we have had over the last 18 months a Goldilocks environment for equities. We've seen one of the strongest macro recoveries we've seen at any point over the last 20 years. Plus, real bond yields, the discount rate for equities, have fallen to an all-time low. And as the logic of a discounted cash flow model tells you, if growth goes up and your discount rate goes down, that's a fantastic combination. And we simply think that both these trends will reverse. We think growth has to normalize. It is not sustainable at current levels. We've got a lot of cyclical drivers that are now turning into headwinds. And central banks are turning more hawkish. Your colleague was just saying it. There's a lot of inflation. Central banks have to respond. If they do, that means higher real bond yields. And slowing growth and a higher discount rate is not a good combination for equities.
Sebastian, when we talk about strategy, then you've got underweight capital goods and autos, but overweight utilities are typical defensive. But can I just explore that theme around utilities? Because we know that this is an area where there's huge investments required to try and gear up for a renewable future. Does it change the metrics a little bit around this sector? Because we do have this climate change target goal for a lot of these companies to hit.
I think it is a structural support driver, but what we are far more focused on are the cyclical forces. Remember, this is a sector that has just underperformed by 25% since last March. The price relative is at a 2-year low. And what is so surprising for investors is, remember how enamored everybody was with the sector last year. People were talking about ESG inflows, about the bright future for renewables. But it turns out at the end of the day, this is just a defensive domestic sector. So when growth momentum soars to a 20-year high, as it did in the euro area, because you had the reopening boost, a lot of fiscal stimulus, then this defensive domestic sector gets left behind. Everybody else outperforms, it underperforms. So if you ask yourself, when does it ever do well from a cyclical perspective, is when growth is very elevated but starts to slow. And that is the case now. And therefore, we think the time is right for the utilities.
Sebastian, I was very interested to see what the big fish are doing as we got the filings in the United States. And interesting, Warren Buffett is parking some money in a company that does flooring and decor, and a pharma company. And then you've got some of the other big fish buying a glasses maker, as in eyeglasses, and a supermarket business, a grocer. It does feel as though, as far as the American investors are concerned, they're still very interested in the cycle and the opportunity to own consumer goods businesses. How do you feel about the European aspect to this story?
Well, I think the portfolio you've just described, healthcare, pharma, and food makers, these are all very defensive positions. So I would certainly agree with the defensive aspect of it. The one thing I would caution, though, from a European perspective, is that we have a very, very unusual macro cycle. And one of its peculiar features is that you have effectively a decoupling between the macro cycle, which has now clearly peaked and is slowing, and the rate cycle, because central banks have been so slow to respond to the strong macro recovery. So they still are in the process of basically moving towards a tightening stance, and the market still has to discount it. And so what we've seen over the last couple of months, and what I think is going to continue over the coming months, is that growth is slowing, but rates are still catching up with a strong macro recovery. That means rising bond yields in a slowing macro cycle, which, as we know, is a very unusual combination. And that means that a lot of the defensive positions that normally would be attractive in a slowdown, because they're so rate sensitive, it might be too early for them. And so therefore, I would say I agree with the defensive stance, but we have to ensure not to get too much exposure to the kind of sectors that are vulnerable to rising bond yields.
Yeah, and just to circle back then to the central bank interest rate story more broadly, we've already had one market specialist tell us that banks are a good place to be, and the market still hasn't repriced the opportunity in banks with higher interest rates. As you look at Europe, we know, though, that our banks in Europe are still struggling to find a growth gear. And one of the stories we're talking about this morning, I think, is BNP exiting its US business. Are you safe putting money into European banks at this point if you bought something like a blended ETF, maybe?
Yeah, it depends a little bit whether you look at it in absolute terms or if you look at it in relative terms. So as we just highlighted, we think the market is going to go down by 10%. And clearly in absolute terms, it's going to be very hard for anyone to shine in that kind of environment. But we think on a relative basis, banks will outperform. And it's a similar story to what we've just explored to utilities. The one recipe that we recommend is be very aware of what are the main macro drivers impacting all these sectors. And for the banks, especially in this cycle, there really was just one place to focus on, which was the US 10-year bond yield. So in our base case scenario, we expect the bond yield still to rise by another 40 basis points because you have to price in more Fed rate hikes. And banks have just followed the lead from the bond yields almost perfectly over the last 18 months. So if bond yields rise, then banks outperform, even though in absolute terms, they might still be down in a falling market.
So just let me confirm, Sebastian. I mean, I can't eat tins of beans if my relative performance is still negative. But so everything rally turns into an everything decline as and when your scenario plays out.
Yeah, I would maybe the easiest label I can offer you is payback. You have had 100% rally in the US, a 70% rally in Europe, because you had a phenomenal growth acceleration and your discount rate has fallen to an all-time low. All I'm saying is if both these drivers normalize, i.e. growth in the euro area GDP growth does not stay at 6%. And I think we can both agree that 6% is not a sustainable run rate for the euro area economy. And if real bond yields don't stay at minus 150 basis points, then there's a normalization process. And the way basically to describe it, I think it's just payback for the phenomenal returns that you've seen over the past 18 months.
So when this payback happens, I mean, where's going to be the biggest carnage? I mean, you talk about European equities markets coming off, 10% plus downside as well. I mean, presumably if we're going to come off 10%, then the US markets and global markets are going to come off, but what, by similar margin, or because of their bigger CAPE valuations or PE valuations, they come off more, do they? I'm just trying to work out where this happens relatively and where the worst damage is going to be.
Yeah, so within the market in Europe, it's clearly going to be the cyclical sectors. Think about autos. This is a sector that nobody wanted to touch last March. It's now up by 70% because that's what it does in a macro acceleration. So if you get payback there, the market falls by 10%, autos could easily underperform by 10% in a falling market. Capital goods, I think, is a particularly attractive underweight. This is a cyclical winner, has outperformed by 25%. The PE relative is at a 20-year high at a 30% premium. This is a cyclical play where all the good news is priced in and none of the bad news. And then if you look at Europe versus the US, unfortunately, I think Europe is slightly going to underperform simply because A, it's more cyclical, and B, the cyclical slowdown is only just starting in the euro area. So we see more downside for the macro lead indicators in our region.
Always enjoy our conversations, Sebastian. It'd be nice to see you back in London here around the desk at some stage. Are we going to do that anytime? I guess we're not going to do that soon, are we? With the pick. Oh, sorry. Sebastian Redler, who is the head of European equity strategy at BAML.
Finishing my breakfast.
Sorry, I did that to you before on purpose, and it was dastardly.
Dastardly.
So, and we,
Yes.
You
anchor rules.
Anchor rules.
Never bring in the other anchor when they're eating something.
Yeah, but I think it's quite funny sometimes. But you didn't when I did that.
No, it was cross.
No. Anyway, my point being is, guests around the desk, it is a factor of lower COVID rates, and with COVID rates worryingly high across Europe, we're not going to get. Do you know we have this new desk? We've never had guests around it.
That's right. Yeah. It's a
In fact,
shame,
we've
isn't it?
never had three of us round it.
No.
We've never had, James T. Kirk, you in the middle.
Thank you.
Karen. Spock. Me, Scotty.
I might just abdicate myself from this conversation.
Would I be? I'd like to be Scott.
I'd like
He's
to
the
leave
smart
on
one,
time
isn't he?
today.
Well, no, Spock's the smart one, isn't he?
Yes.
Vulcans?
Yes, yeah, definitely.
Yeah, I'll be Scotty. I can't get it working, Captain. Just come back from Glasgow.
Yes. Very good.
You not like to see yourself as a James T. Kirk?
No, not really.
Jean-Luc Picard?
No, not particularly. No.
Darth
I
Vader?
think this analogy's run out of road, hasn't it? How are HomeServe doing?
I'm not going until you play. British home repair firm HomeServe, I didn't feel it's quite good personally, posted a 27% jump in pre-tax profit in its first half as the company, he's spewing on his tea now, as the company says it's emerging strongly from the pandemic and forecasting significant longer-term growth. Speaking to this program, HomeServe founder and CEO Richard Harpin said the firm, according to my read, is retaining its workforce.
We've got a very loyal direct labour force of engineers doing those home emergency repairs for customers. We're not seeing significant attrition in our call centres, though we are automating a lot of calls now, and that's a very exciting opportunity for us. So we're not seeing major pressures on our business labour-wise.
All right, coming up on the show, oil rebounds after a weaker start to the week, but the energy transition is still in focus after COP26. We'll hear more from our team on the ground at the annual ADIPEC Forum after the break.
So very shabby, the gold so far. Now, summary for Asian session. I will send it right now.
Oil prices are rebounding despite worries over rising COVID cases in Europe and concerns over the impact on growth prospects. But the transition to clean energy is still a major focus after the COP26 summit wrapped up, with oil and energy giants gathering at the ADIPEC Forum this week to discuss ways to become more climate friendly. Let's get out to Hadley and Dan now, who have obviously been talking to some of the major players there in Abu Dhabi at ADIPEC, and perhaps can give us a line on why, for many of these companies, they would bother at this point when surely the goal is to extract as much money as they can with the resources that they're still able to sell.
It's an excellent question, Jeff, and one that we've been discussing, as you say, with various members of the industry. I had the chance to sit down yesterday in a major panel with the CEOs of BP and Eni, as well as Lukoil and Occidental. I pushed back on the CEO of Occidental, actually, and said, listen, at the end of the day, are you concerned about the fact that the Biden administration is basically going hand in hand to OPEC Plus when it comes to production, when they've got their own oil and gas sector back at home? And she said, if I were going to make a call, it would be local, not international. Anyway, one of the other themes that we've been discussing is the representation at this conference. Only one major oil and gas producer, Occidental, has been present. Another major oil and gas producer, Lukoil, very, very interesting, oil producer. And I asked him about President Putin. I asked him about when I was in Moscow a couple of weeks ago. Essentially, they were saying to me, he's not going to attend COP26. I said, well, is the president going to come to COP27 and COP28 right here in the UAE? Listen to what he had to say.
Our delegation has been very active in the event, and pretty much all the decisions were supported by my country. And I'm confident that next year, President Putin will participate in the COP meeting in Egypt, COP27.
So not so much interest in attending COP26, but apparently the president will be present in Egypt for COP27.
Yeah, and really interesting to hear oil and gas executives sounding pretty upbeat on COP28, which is of course going to be hosted here in the UAE. They say bringing the climate conversation and the narrative around oil and gas into the MENA region is going to be really important when it comes to advancing the outcomes of COP28. Of course, not just oil and gas on the agenda here as well. We've also heard from a number of technology executives. And this is interesting because we have big tech companies looking to make a play into the oil and gas sector because they say we can use technology, we can use AI, we can use cloud to help accelerate the energy transition. I had a chance to speak with the CEO of IBM late yesterday. We spoke about this new partnership that it's launching with Amazon to help accelerate the energy transition. But I also had a chance to ask him about how he's viewing the global economic recovery and if he sees any risks on the horizon into 2022. Listen.
Geopolitics always comes into play, and I would turn around and say, but we have no control of that. So I'm going to go punt that on the side. First, let's acknowledge we still have a pandemic upon us. It's not yet an endemic. So I think if some weird new variant comes around, even worse than Delta, that would bother me because I think it'll cause a temporary, not a permanent slowdown. I have so much confidence. We have the correct protocols. We have vaccines. We can go fine tune these vaccines. So I think that there is a way, but it could cause a temporary slowdown. Then with all of the liquidity and the fears of inflation raising its head, that could cause some chaos in this thing. By the way, I don't think that's a 2022 threat. That's probably later than 2022.
The CEO of IBM there, calling a warning, I guess you could say, on inflation and also other issues that could derail the energy and global economic recovery into next year. But also interesting to hear the conversation around OPEC as well. You know what, when it comes to oil prices, it seems like oil and gas executives are pretty comfortable with where oil is at right now, at around that 80 USD level. Still a lot of uncertainty about what's going to happen over the next few months.
Can you hardly blame them?
They love it. They love it.
Yeah, and at the same point, all those conversations surrounding inflation, echoing on from what you got from Mohammed Al-Aryan earlier. One of the big questions that I was asking the CEOs was, are you worried about how much money that we need to be putting into the industry? Are we going to already be on the back foot? Talk to Dan Jorgen, talk to Hilly McCraw. Both of them say this is a real problem and a challenge for the industry. And they know it, and here we all are. Guys, we're going to hand it back over to you.
Thanks so much for the conversation, guys. We'll catch up with you a little bit later on programming. Meanwhile, we need to squeeze in a break. When we come back, we're also going to talk lithium batteries. Northvolt unveils its first ever battery cell made from 100% recycled materials. We're going to catch up with the CEO of the business in just a moment.
In the headlines today, the Stock 600 climbs to another record high, leading the pack Vodafone and HomeServe after both companies hike their outlooks. The Dutch government reportedly launches a last-ditch attempt to keep Shell in the country after the oil major announced plans to shift its tax base to the UK and end its dual share structure. Drinks giant Diageo lifts its organic sales growth expectations in the short and medium term, but warns of increasing inflation pressures. And US President Joe Biden warns relations with China should not veer into conflict. Holding his first official talks with President Xi Jinping, he calls for win-win cooperation.
It seems to me we need to establish some common sense guardrails to be clear and honest where we disagree and work together where interests intersect, especially on vital global issues like climate change.
So, interestingly, we have more stocks in negative territory than in positive territory, and yet we're still up on the Euro Stock 600, which, of course, as you all know, means that the gains that are being made are greater than the declines that we're seeing. So let's have a look at the individual sectors. What was it before? It was technology, retail, and oil and gas were leading us higher. We have telcos, oil and gas, and autos in positive territory. Retail is still up there. A little bit of a downtick for utilities and healthcare. Construction and financial services also mildly in negative territory. One or two names for you. Let's just pull out. Is Vodafone up? Yes, it is. 4.4% higher. So just building on those earlier gains. Look, I didn't think the growth was great in terms of a historical basis, but I think it was clearly better than the market was expecting. And the cash flow improvements and the reassurance on the guidance going forward, meaning Vodafone is 4.4% higher today. ThyssenKrupp is up 5.1%. Elsewhere, HomeServe, we were talking, and Diageo, we've done both those stories this morning as well. Diageo up 2.4%. HomeServe also on the front foot. HelloFresh down 2.1%. J. Martins over on the Portuguese market on the Lisbon Exchange down 11.2%. Let us move on. Northvolt has produced its first battery cell manufactured from 100% recycled nickel, manganese and cobalt. The Swedish battery firm, whose backers include Volkswagen and Goldman Sachs, says the cell performs at a level comparable to those made from freshly mined materials. Now, Northvolt will expand its recycling facility with a view to recycling 125,000 tons of batteries annually from 2023. Well, let's get to Emma Nerenheim, who is the Chief Environmental Officer over at Northvolt. Really nice to see you today. Well, look, congratulations on this battery and congratulations on the performance. We hear a lot about the circular economy these days in very vague terms. This is you actually putting some meat on the bones of that concept. Just tell us a little bit more about it.
So, as you know, Northvolt already from the beginning committed to becoming the greenest battery on the planet. And as part of that, we already said upfront that we wanted to have 10 kilograms per kilowatt hour produced battery in terms of carbon dioxide footprint by 2030. And also by 2030, we want to have 50% recycled cathode material in our cells. And this is a huge milestone for us. We have worked to get to this point since basically 3 years back, technology-wise, and we built up a pilot plant. And now we're also scaling up in Skellefteå, where we have our gigafactory.
Yeah, I mean, looking at your backers, Goldman Sachs and Volkswagen as well, how scalable is this at speed to get these batteries into vehicles?
It's very scalable. We are building an industrial plant now, and we are planning for a giga scale, of course, recycling on the same site as we do our battery production. And the key here is that we have a vertically integrated plant. So our battery production, compared to most other cell manufacturers, also has cathode material production on site, meaning we can buy lithium, and nickel, manganese, and cobalt as raw materials and use it already up front. And this enables a close local recycling on the site. The bottleneck, as you know, is, of course, to get the material back. But we are coming to that as the market is growing.
How does a European battery business compete against the Chinese at this point, Emma?
I mean, at this point in time, we are in a race. Europe needs to step up. We are part of this. We want to have a local production in Europe. It's important for us. It's important for the footprint of the batteries. It's important for expanding the knowledge. We think that our sort of differential factor is primarily sustainability, and we have the highest standard on that, and we are continuing to prove that.
It's an incredibly capital-intensive business at the moment, as you know very well, and we've just seen Johnson Matthey fall by the wayside in their endeavours because clearly their pockets weren't deep enough. Can Northvolt make it to the end in this race against the Chinese without significant government support?
I mean, we have a great support within Europe. And we're going to have to make it. I mean, we have to do this sustainable. We have to do this in a circular economy within Europe. And of course, upfront is a bit capital intense, but in the long run, this is going to be also sustainable for the economy of the EV market.
Can I ask you about the landscape now for battery technology? Because there was a big push by some European leaders to create some sort of ecosystem here. Do you think that this breakthrough has been possible because there have been strong moves towards this battery ecosystem in Europe, or is that just still ahead of you?
I think you're onto something here. I think it's incredibly important to recognize that in order to set this, the collaboration needs to go across the battery manufacturers like us, our customers, the car OEMs or the car makers, their customers, but also the recyclers, the collectors, the compliance schemes for battery recycling, and of course also the regulators. And we see a very, very strong commitment from the European Commission right now in putting forward a regulation that strongly supports this.
A slightly trickier question rather too around what you do at the end of the road with these batteries, because I mean Jeff brought up the Chinese, but what we've seen in the semiconductor market with shortages is that those with very strong relationships have been able to access the product and have had fewer issues than others. With this battery technology, and given the European partners you've had, is it first dibs for some of the European automakers for your technology?
I would say that there is something to that for sure. And I also think that long term, this is going to make the market more robust. If we are able to take care of the batteries and mine in our backyard, as we used to say in the days when urban mining was becoming big, this is going to be the thing that is removing a lot of the volatility that we can see in the raw material market, and that can also enhance the ability to build business models that are fully circular together with the stakeholders I just mentioned, and to really make sure that we control the materials throughout this circular market.
Emma, were you disappointed by COP26 in terms of the mealy-mouthed stance from the automakers who said, no, we can't commit to something towards the tail end of the next decade for pure EV production and no ICE production because we don't think the infrastructure is in place? Don't you think that was just a bit underwhelming from a whole host of the major manufacturers, including perhaps one of your backers?
I mean, from a personal point of view, I of course would like to see a great push. I also, at the same time, recognize that it is an infrastructure build-out that is needed. I think that that's partly in the hand of the car makers, but I think there is also a bigger commitment needed from the wider audience. We need to have incentives in place also for that piece. We need to have storage systems out in the grid. We need to have better ability to build out renewable energy, and we need incentives also for that. We need to step away from any kind of certificates that does not incentivize build out of renewable energy and so on and so forth. I do think that it's incredibly important that we start looking at this more widely. I think that the technology is there. It's about time for the entire European Union to decide that we need a full EV supporting grid and the transmission system and distribution system and storage to build out the charging infrastructure for EVs, but also for buses and trucks and all other kind of transportation means.
Emma, that's the second time you've mentioned the European Union in your answers today. Do you think that despite Fit for 55 and everything that Frans Timmermans has told me and everything that the Commission President has said as well, that actually the actions aren't yet backing up the rhetoric?
I think that we are getting to it. I think that now we just need to put the foot in the ground and decide that, yes, we trust this, and this is where we're going to be at by 2030. We're gonna be fully built out, and then it's going to work for everyone to buy an EV and run that on the streets.
I couldn't agree with you more about the infrastructure. We need, certainly in the UK as well, we need the government to put their money where their mouth is and scale as well. Thank you, Emma. Very nice conversation there. Emma Nerenheim, who is the Chief Environmental Officer at Northvolt. And I've gone past it. For more on our coverage of Northvolt, Katrina said, look, just get this story up. It's good. So I will. Head to cnbc.com. Karen.
Elsewhere in the EV market, Elon Musk's share sale has continued into a second week. The billionaire has sold another $930 million in Tesla shares to cover tax obligations stemming from the exercise of stock options. Musk had exercised options on Monday to buy over 2 million shares at $6.24 each, and so is required to pay income tax on the difference between the exercise price and the fair market value. Musk sold just under $7 billion worth of stock last week. And Tesla is being sued by JP Morgan for more than $160 million. The bank is alleging a breach of contract over stock warrants, which expired this year, saying the warrants obliged Tesla to deliver shares or cash if its stock was worth more than the strike price at the time of expiry. JP Morgan repriced the options twice after Musk was sued for fraud by the SEC in 2018. Tesla is yet to comment. Jeff.
Warren Buffett's Berkshire Hathaway added stocks including Royalty Pharma and Floor & Decor in the third quarter, while cutting his stakes in some drug stocks such as Merck, according to a new 13F regulatory filing. CNBC's Leslie Picker has taken a closer look at the filings.
We did receive some 13Fs. These are as of the end of the third quarter, so the positions may have changed in the 6 weeks since then, but some really interesting moves by Berkshire Hathaway during the quarter. For one, the firm boosted its stake in Chevron by about 24% to hold $3 billion at the end of the quarter. Also paring back some stakes in the healthcare sector, decreasing its stake in AbbVie by about 30% to hold about $1.5 billion at the end of the quarter, sold out of Merck completely, and sold down about 16% of shares held of Bristol Myers Squibb. However, Berkshire Hathaway did maintain its stake in Teva and took a new $500 million stake in a firm called Royalty Pharma, which was trading higher on that news. Also taking a small stake in a company called Floor & Decor, which also reacted positively to the revelation that Berkshire Hathaway was a new owner. During the quarter, Berkshire Hathaway did have a small trim in Visa and MasterCard, as well as U.S. Bancorp, but he still maintains a $7.5 billion position in U.S. Bancorp. For CNBC Business News, I'm Leslie Picker.
Coming up on the show, US President Joe Biden held his first direct talks with his Chinese counterpart Xi Jinping as the pair look to de-escalate tensions on a number of hot-button issues that we'll discuss next.
politics, and Belarusian President Alexander Lukashenko has held a phone call with Germany's Angela Merkel amid the border crisis with EU member state Poland. This according to Belarusian state reporting, with no further details provided. The conversation marks the first contact between Lukashenko and a Western leader since 2020, when he ignited massive protests after claiming victory in a controversial presidential election. Meanwhile, Russian President Vladimir Putin and his French counterpart Emmanuel Macron have agreed the migrant crisis in Belarus must be de-escalated after a nearly 2-hour phone call yesterday. The two leaders did not agree on the origins of the situation, but Macron remains hopeful the conversation will, quote, yield results in the coming days. France has also told Russia that NATO is prepared to defend Ukraine, where the alliance says the Kremlin has been building up troops. The US State Department has accused Minsk of creating the border crisis as a distraction to Russia's increasing military activity near Ukraine. The European Union will also ramp up sanctions against Belarus, targeting airlines, as Poland reports nearly 4,000 people are trapped in freezing forests on the border.
Presidents Joe Biden and Xi Jinping have held the first direct talks between the superpowers since the administration took office. The virtual summit, which lasted just under 2 hours, saw both heads of state call for cooperation and the implementation of measures to avoid conflict. Biden stressed the need to set ground rules and improve communication.
It seems to me we need to establish some common sense guardrails to be clear and honest where we disagree and work together where interests intersect, especially on vital global issues like climate change. Our bilateral relationship evolves seems to me to will have a profound impact not only on our countries, but quite frankly, the rest of the world.
The Chinese premier stressed the need to avoid playing, quote, zero-sum games, and that Earth is a, quote, global village big enough for the development of both superpowers.
As the world's two largest economies and permanent members of the UN Security Council, China and the US need to increase communication and cooperation, each run their domestic affairs well and, at the same time, shoulder their share of international responsibilities and work together to advance the noble cause of world peace and development.
So we started this actually when we began the programme 3 hours ago, when we were talking about the progress, hopefully, that this implies for an improvement in the relationship. And I thought you made a good point about, well, whose rules ultimately are both these parties going to be abiding by? But there are so many issues now on the table where there are differences of opinion. I think it would just be useful if we could dial down the rhetoric and the noise and actually try and make some progress on the constructive areas, if that is possible, given the competing nature of the two systems.
There are certain issues that you can't, because China sees them as domestic issues. The US and the West see them as broader, either geographic or human rights issues. And of course, we're primarily talking about Taiwan. We're talking about Tibet. We're talking about human rights and the Uyghurs. We're talking about Hong Kong. Now, again, we don't need to get into sides on this, but we can say very clearly that the West sees those as global issues, as human rights issues, whereas the Chinese see them as domestic issues. Nothing is going to change from the Chinese saying that Taiwan and Hong Kong and the Uyghurs and Tibet are domestic issues, and nothing is going to change from the West saying, well, actually, Taiwan has a right to be independent or is democratic. Obviously, we're a bit mealy-mouthed at some countries about whether it is independent or not. And again, that's not something I want to step on at this moment in time. But the fact of the matter is, China sees them as domestic. The West sees them as international issues. And I don't see how you can make any progress on that. Where you can make progress, hopefully, are on bilateral trade relations, on the governance in the South China Seas, and basically perhaps movement of various types of shipping there as well. You can make progress, hopefully, as we saw at COP26, on bilateral agreements regarding climate as well. So there are areas that clearly both sides can move ahead with and want to move ahead with. But there are other areas where I can't see anything other than the current and previous logjam that Obama was beset by, that Trump was beset by, and that Biden is continuing to be beset by.
Yeah, so far, I mean, we picked over all the major issues, haven't we, when it comes to Taiwan, but also the Uyghurs. But what about the big technology race? And here you're still seeing leaps and bounds from the Chinese, including this domestic crackdown. You think what it was about. It's about directing expertise, intelligence away from just pouring it into social apps and photography sites. The Chinese want that expertise going into very smart industries that take them ahead in future. And we're talking not just smartphones anymore, we're talking electric vehicles, how you power this new technology with AI chips, drones in future. So these are natural areas of competition when it comes to the Americans as well. And don't forget there are limits and curves on how this technology can be used. I mean, you think about through face identification, facial recognition technology, a lot of big US technology companies have had to pull back on that technology for what it means for society. There's sort of implications around profiling. The Chinese are very much going down this pathway, giving them superior capabilities. So you've got a real clash of culture around technology in future. And I think, too, that may still lead to a separate system between whether Chinese tech is going to be used in American-made technology products in future and vice versa. Jeff?
Just to wrap up, I mean, the issue, I think, for China watchers is this is not Jiang Zemin's China. This is not Deng Xiaoping's China. This is Xi Jinping's China, which has taken a very different tack now on domestic technology companies, on the competitive nature of the relationship with the United States and the West, and this new pledge, common prosperity, which I think we're all still trying to get our heads around at this moment. But what are the implications of common prosperity for things like market access for foreign companies into China, for example, when the focus is on leveling down or leveling up those who are seen as less well off than obviously some of the big Chinese business people and entrepreneurs. So we're all coming to grips, I think, with the idea of Xi Jinping's leadership and what ultimately the new China is going to look like. And it doesn't look like a China that is as pro-West or as pro-Western technology or as friendly in geostrategic terms as the China that existed before. And obviously, I think we're going to be butting heads for some time to come then in the ongoing relationship and on many of those key issues that we've talked about already on the programme. We're going to wrap it up on Squawk Box. Street Science is coming up in just a few moments. Thank you for tuning into the programme. We'll see you tomorrow.
You can see pound yen hanging right there. So if you are long, because the yen started going green, it used to be red. That's why this is a good time. Maybe the market is gonna hanging around. Okay, so if you are in profit, you can exit and wait for a pullback, because right now is not this is used to be red, so this is like a warning. Maybe we can get a pullback, and we can see after that what's the signal here. But it looks like the pound New Zealand is still strong to the upside. I mean, we still have a clear road to upside here, but I don't like what I see here on the Aussie or pound yen. Even pound Aussie start going green. But even when it's going green, is not the market is not pulling very hard. I mean, you can get like 5-6 pip dip and the market go back higher. So let's watch it closely, because this is gonna tell you exactly where you can get out, where you can get in, or when you can stay on the trade. You know what I mean? On the grid, you can see the road is clear. So maybe we can go to 53.99, 54. But I don't like the green here. I mean, we're just gonna hang out right here, but we're just gonna waste a lot of time. So it's better move to another trade.
Good morning and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. The International Energy Agency signals a reprieve from the crude price rally could be on the horizon as the group forecasts further growth in supply to round out the year. The Dutch government reportedly launches a last-ditch attempt to keep Shell in the country after the oil major announced plans to shift its tax base to the UK and end its dual share structure. The Stock 600 climbs to another record high, with Vodafone and HomeServe among the top gainers after both companies hiked their outlooks. And U.S. President Joe Biden warns relations with China should not veer into conflict, holding his first official talks with President Xi Jinping, who calls for win-win cooperation.
It seems to me we need to establish some common sense guardrails to be clear and honest where we disagree and work together where interests intersect, especially on vital global issues like climate change.
Well, a very warm welcome to the program, everybody. I want to kick things off with a look at energy markets. The world oil market remains tight by all measures, but a reprieve from the price rally could be on the horizon. That's according to the International Energy Agency. The Paris-based body forecasts global supply will rise by 1.5 million barrels per day through November and December after strong gains in October. On the demand front, the group left its projections largely unchanged amid renewed COVID concerns in Europe, weaker industrial activity, and higher crude prices. This all in a report just released in the last minute and a half or so. Let's take a look at oil markets this morning. We've got WTI and Brent trading higher. WTI around $81 a barrel. Brent up about 0.8% a barrel to about 82.72. Now, in terms of the IEA report, I had a quick look at the headlines coming out, and the IEA noting that contrary to hopes expressed in Glasgow at COP26, this is not the world oil market remains tight by all measures, but a price rally could be on the horizon. It is not because demand is declining, but rather due to rising oil supplies. And on that note, they say they have raised their forecast for the U.S. by 300 barrels a day for Q4 and by 200 on average for 2022. So the U.S. now set to account for 60% of 2022 non-OPEC plus supply gains. So this story very much about the supply side, and they say that increase will go some way to meet rising demand, still recovering from the 2020 COVID slump. So those are the key takeaways from the report, but let's dive into the detail with Toril Bassoni, oil market analyst at IEA. Toril, great to have you on the program. So looking at the report you released just moments ago, you left your demand forecast largely unchanged versus your last report, yet you note that the tide is turning. So explain to us why you think a reprieve from the price rally could in fact be on the horizon.
Good morning, and thank you for having me today. So as we note in our report, the market remains tight, but after a period where we've seen supply undershoot, OPEC production cuts have been taking a lot of supply off the market at a time when oil demand is rising. Now we're seeing, as we head towards the end of the year, we're expecting continued strong growth in demand, but supply is finally on the rise. So OPEC Plus is continuing to unwind their cuts, but we're also seeing higher supplies from other producers outside of the group. So we're seeing that the market is moving closer to balance. So in September, the latest month for which we have final data, we saw OECD inventories dropping by about 50 million barrels a day. It's enormous. Preliminary data for October showing a slight build in stocks, and this is one of the reasons why we're seeing prices already coming off their recent highs. So as we move into 2022, demand is expected to fall seasonally, albeit rising from the pre-COVID levels. And as OPEC Plus continue to unwind their cuts, we're seeing the markets moving to balance. So this is what we had in mind when we're saying that the market is looking less tight as we move ahead.
To what extent are stronger oil prices incentivizing U.S. producers to pump more?
So, as you just highlighted in your introduction, we have increased our forecast for U.S. supply growth in this month's report. Even though the public companies are still maintaining their pledges for capital discipline, returning cash to their shareholders, we are seeing an uptick in activity, especially from private companies, but also public independents and major companies are increasing the rig count. $80 WTI are leading to increased rig counts. We're drawing down the DUCs, so we're expecting growth in U.S. supply for the remainder of the year. Next year, U.S. oil supply total liquids up by 1.1 million barrels a day. And so this is really due to the higher prices.
There's a lot of speculation that President Biden could use the strategic petroleum reserve to ease the rise in gasoline prices. And I found it interesting in your report that despite the rise in gasoline prices, we are still seeing exceptionally strong demand for petrol or gas, as you would call it, in the U.S. Do you see President Biden going ahead with this move?
We leave that decision up to the U.S. administration. But just to say a few points on the gasoline demand in the U.S. has been very, very strong indeed. We're not seeing the seasonal slowdown in gasoline demand after the summer that we normally see. We're seeing mobility very strong in the U.S., but also in Europe and parts of Asia. Public transport rates are very low. There's a strong pent-up demand. But as gasoline prices are rising, not just in the U.S., but in Europe and in Asian countries as well, we're expecting that the prices will put a cap on the growth in gasoline demand. But there is a lot of pent-up demand for travel, mobility. After a year and a half of COVID lockdowns, there's very strong demand indeed.
Is that at the expense of air travel and in turn, of course, demand for jet fuel?
Yes. So in this report as well, we're noting that jet fuel demand is finally rising. Jet fuel has been the product that has been suffered the most from the COVID, but now more and more countries are opening the borders. The U.S. opening to international travel. We're seeing some tourist destination in Asia, Thailand, Singapore, easing restrictions. But still, and domestic travel for on air has been very strong in China and in the US so far. But there are still restrictions and it's still complicated to travel. The recovery in jet has lagged expectation, and we actually revised down our forecast for jet fuel in this report. So instead of driving or flying and going on vacations abroad, we have seen that a lot of consumers in the US and Europe have taken their cars instead for their vacations or to visit families. So far that has been part of the reasons for the strength in gasoline. We are expecting jet kerosene to increase going forward, but the latest rise in COVID cases in Europe and in parts of Asia are putting a cap on that as new restrictions are coming in place. And this is one of the reasons we're taking a modest growth outlook for 2022.
Really interesting to see that trend is persisting, that preference for driving over flying, even as economies reopen. In terms of what's happening in natural gas, LNG markets and the tightness we're seeing there, how much is fuel switching to oil due to the shortage of natural gas, LNG and coal due to support demand heading into the winter months?
We estimated that the switching from gas and coal into oil for power generation would add about 500,000 barrels a day of oil demand from the power generation sector over the winter months. That is assuming normal winter weather. This month, we're actually revised that forecast slightly lower to about 400,000 barrels a day additional demand, as we're seeing some of the shortages are alleviating. There's more coal coming to market in China and India, notably, and gas prices are also coming down in some countries. So we're expecting about 400,000 or 500,000 barrels a day of additional demand for oil from the power generation sector in the fourth quarter and the first quarter. But we're seeing some of the strains on the other fuel sources easing in recent weeks.
Toril, Fatih Birol, the executive director of the IEA, said that the chances of reaching the 1.5 degrees Celsius target when it comes to the fight against climate change was near zero if we don't phase out coal. I know you focus on oil markets specifically, but I'm curious your take on the conclusion from the COP26 summit, the watering down of the language around coal, and your overall takeaway from the summit.
Thank you. So phasing down coal or phasing out coal is obviously critical to meet the climate target. But we're seeing a lot of countries taking steps to reduce the use of coal for power generation. But there are different objectives in different countries. We're not all starting at the same place. But it was very interesting to see, and we're hopeful that the steps will be taken so that all countries can switch out of coal to reduce their emissions, that we come up with solutions together on how best to do that, finding clean alternatives. The push to increase investment in clean energy technologies in developing countries, and especially those that are reliant on coal, is very encouraging. So we're hopeful that all the countries that came together at COP26 now move forward on the pledges that they made, that they put the legislation in place, and that the investment that is required do come in the places where they're most needed. So we're hopeful that we will get there.
Toril, we'll leave the conversation there. Thanks for joining us on the back of this report. Toril Busoni, oil market analyst at IEA. Now, oil prices are rebounding despite worries over rising COVID cases in Europe and concerns over the impact on growth prospects in the United States. President Biden is under pressure to release emergency oil reserves to cool skyrocketing gasoline prices, as just discussed with Toril. Now, Biden's response, as well as the conversation around clean energy transition, remain key topics at this year's ADIPEC forum. Hadley Gamble caught up with the CEO of Occidental Petroleum and asked whether the shale industry in the United States could be in trouble amid the push for more sustainable energy.
What gave the shale industry a bad name were the companies that had a model of growth and growth only. And if you want to grow and only grow, and you're continually outspending your capital dollars are more than your cash coming in, you never make any income. And ultimately, the model doesn't work. The model has to fail at some point. We're not developing our shell in that way. We're developing it similar to the way we develop our conventional oil and gas. And that is, we're building infrastructure and facilities and maximizing net present value and getting the highest return on those assets. And those are quick return.
Dan joins us now from ADIPEC and Abu Dhabi. Dan, amazing timing for this conference right on the heels of COP26 in Glasgow. Where has the conversation gone from what happened in Glasgow? What have been the main debates at the conference so far?
Hi, Juliana. Well, as you heard in Hadley's conversation there, the primary focus among the oil and gas executives that we've been speaking to on the ground here at ADIPEC is what's going to happen next with prices as we see oil back above $80 a barrel. And of course, what is going to be meaningfully achieved after COP26. Of course, what we're going to see now is the climate conversation very much coming into the MENA region, with COP27 set to be hosted in Egypt and COP28 coming to the UAE. So oil and gas executives very much focused on climate as we speak. Of course, when it comes to the outlook for oil prices, many are quite optimistic as well. I had the opportunity to speak with the notable market commentator Mohammed El-Erian, Chief Economic Advisor at Allianz, in a 45-minute conversation on stage yesterday discussing a range of issues. I asked him about the prospect for 100 USD oil, which is something that has really come into the market vernacular over the past few months as we see the oil market recovery continuing to take shape. He threw some cold water on the idea that we would see 100 USD oil anytime soon. However, he did say we can't rule it out. Listen into some of this exchange.
If you were to focus only on the supply side, you could get to oil at 100 because there's been underinvestment in the industry in general, and demand will stay robust. But if you look at what's happening on demand side, there you get some questions. Demand is robust today, but will it be robust in 6 months' time? And there's really big questions, both in terms of demand destruction, people buying less because prices are higher, and in terms of whether policy becomes contractionary or not.
Mohammed El-Erian there. It was also interesting to get his view on inflation. We know that this is something that has been on his mind for several months now. He's been really vocal in calling out the transitory nature of inflation, at least according to the US Federal Reserve. He says the Fed is getting it wrong and they need to be more attuned to realities on the ground. He says that is probably the primary risk for the global economic recovery heading into 2022. I also had the chance here to speak with the CEO of IBM, and I asked him what's keeping him awake at nighttime. Is he concerned about the inflation narrative? And more broadly, what other risks should investors be attuned to as we track into the start of a new year? Here's how he responded.
Geopolitics always comes into play, and I'll turn on and say, but we have no control of that. So I'm going to go punt that on the side. First, let's acknowledge we still have a pandemic upon us. It's not yet an endemic. So I think if some weird new variant comes around, even worse than Delta, that would bother me, because I think it'll cause a temporary, not a permanent slowdown. I have so much confidence. We have the correct protocols. We have vaccines. We can go fine-tune these vaccines. So I think that there is a way, but it could cause a temporary slowdown. Then with all of the liquidity and the fears of inflation raising its head, that can cause some chaos in this thing. Oh yeah, I don't think that's a 2022 threat. That's probably later than 2022.
You're not worried about inflation right now?
I'm always worried about it, but I'm not sure it'll have an impact on the business in 2022. So there's a subtle difference between the question was, what am I worried about the business? No, I am worried about inflation. That's why I raised the question. But I don't think it'll cause an impact on the business. But he also has a bird's eye view. I'm seeing more demand for technology than at any time during my career. I think that technology has kind of become the basis on which most companies and enterprises and governments do their thing. Take simple examples, like restaurants, stores would all have fought omni-channel even 2 years ago. Now, because of the pandemic, they all thought they need it to survive. But once they did it, they realized, wait, but that opens up my market. It's actually not more expensive, maybe cheaper to serve my clients this way. And suddenly this has opened up ways of doing things that people hadn't thought about. People in a certain demographic didn't want to do online. Everybody did online over the last 2 years. Countries like India leapfrogged onto e-delivery of everything. So to me, this has opened up an opportunity for technology, the likes of which we have not seen. I think Y2K may be a small approximation of what we're seeing. So I see tech spending heavy even through this environment.
Anand Krishna speaking to me here at the ADIPEC conference late yesterday. You're probably wondering, what is the CEO of Big Blue doing at an oil and gas conference in the Middle East? He was actually out here to announce a brand new partnership with Amazon. IBM looking to work with Amazon on the energy transition. They say they can lean into capabilities in areas like data, AI, and cloud, for example, to help IOCs and NOCs do more to achieve their climate goals. Let's see what happens in that space. Juliana, ultimately, I would say 2 key takeaways from the conference so far. Number one, oil and gas executives pretty confident, I guess you could say, on the outlook for the oil market recovery, while they are still concerned about inflation and other issues. And number two, they very much recognize that climate is at the center of these conversations now, and they are keen to progress the outcomes from COP26. Exactly how they do that, though, remains to be seen. It's back over to you.
Dan, thank you for your coverage. Really interesting conversations you've brought us there. We've got another oil major in focus this week, and that is Shell. The Dutch government is reportedly scrambling to stop Shell from fully relocating its headquarters to the UK. The plan emerged after the oil giants revealed it is overhauling its structure to a single share system and moving its tax residency to the United Kingdom. According to the Financial Times, the Dutch government wants to hold an 11th hour vote to scrap the country's dividend tax, which has long been a source of complaint for Shell CEO Ben van Beurden. Coming up on the show, we'll bring you Anetta's interview with RWE CEO Markus Kreber as the German utility group unveils a 50 billion euro investment drive to become net zero. But question marks hang over supply bottlenecks and its coal-fired plants. We'll be right back. Welcome back to Street Signs. Let's get a check on European markets. We're just about an hour and a half into the trading session, and we were off to another positive start here in Europe with the Stock 600 hitting yet another fresh record high. Yesterday marked 12 positive sessions in the last 13 for the Stock 600. We also saw the DAX and the CAC 40 hit fresh all-time highs as well. So a very solid performance out of European markets, drawing somewhat of a contrast to their U.S. peers, which had a fairly muted session yesterday. Turning to individual bourses, this is what the picture looks like from a regional perspective. A bit of red on the board for the FTSE 100 and just a touch for Italian stocks as well. The German index and the French index both continuing higher. And again, this comes after fresh record highs for both those markets yesterday. In terms of investor focus this morning, Biden and Xi's virtual meeting certainly at the front of people's minds. Both presidents appearing to try to stabilize the relationship or send messages along those lines, but no major announcements have come through yet. Investors on high alert for any headlines, especially on tariffs to come. And then on the downside, we are continuing to watch COVID cases rise across the globe. A number of countries in Europe now moving to toughen up restrictions in response. So far, though, investors taking that news in stride. From a sector perspective, this is the picture this morning. We've got the majority of sectors trading higher. Telecoms out in front, up 1.2%. Vodafone, the huge mover in there. We'll come on to it in just a minute. Autos up about 0.8%. Basic resources and oil and gas. And then on the downside, we've got a bit of selling pressure in construction and materials, utilities, and healthcare. Vodafone has hiked its free cash flow guidance after posting adjusted core earnings growth of 6.5% in the first half of the fiscal year. The European telco group pointed to Germany as its key growth driver. CEO Nick Reed said the group is on pace to meet its guidance for the year, as well as its medium-term financial targets. And we've seen a strong share price reaction in Vodafone. Meanwhile, Bouygues saw profits swing back to pre-pandemic levels in the third quarter, topping estimates at 1.14 billion euros. The French industrial giant says performance at its broadcast business, as well as its construction arm, helped drive margins higher. The group confirmed its outlook for 2021 as it prepares for a slew of M&A activity next year, aiming to close the deal between TF1 and another broadcaster, M6, and completing its acquisition of energy group Engie. And there you've got Bouygues shares trading about 2% lower this morning. In the financial sector, BNP Paribas is mulling a $15 billion sale of its U.S. arm, Bank of the West. That's according to Reuters, which says the bank is working with JP Morgan and Goldman Sachs to prepare the business for sale. Speaking to our colleagues in Singapore, BNP Paribas chairman Jean Lemierre refused to be drawn on what he described as rumors.
You read the press, I read it, and I read articles, and you understand that I'm not used to making comments on the rumors, if I may use that word, which have been published. They are rumors. I don't make comment.
RWE has unveiled a 50 billion euro investment drive into green energy as it aims to reach net zero emissions. The German utility group says it plans to finance the transition from its own cash flows, with the bulk of investment going into solar, wind power, and batteries. RWE shares jumped almost 3.5% on the announcement, although critics point to its continued reliance on fossil fuels. And now shares are pulling back somewhat this morning. Currently, they're trading just about 0.6% higher. Annetta joins us now with more. Annetta, looking at the headline numbers, this seems like a major investment drive from RWE. Just how significant is it? And what are the key debates for investors on this stock?
Well, actually, it's very significant. It's a completely revamp of what had been the old RWE, very much relying on coal. But clearly, Germany has to exit coal and nuclear at the same time. And they are also promising, or at least putting a slight probability on a possibility that RWE will exit coal earlier than previously anticipated. But everything, of course, depends on how fast the other capacities can be built up, because clearly they have to produce enough energy. And that is a key element of that whole plan. And here comes gas power plants into play, even though they are in the long run, not environment, they are not wanted because they're clearly also producing carbon. but still they are needed for energy security, not only in Germany, but elsewhere as well. So essentially, as I said, it's a huge transformation of the utilities industry. And of course, the key question is how to finance it all together, because 50 billion euro, it's a lot of money until 2030.
Our growth plan is fully funded. We can finance it with our strong operating cash flow. And then partly we do farm down, so we sell stakes in our projects or partner with others. And that is more than enough to fund our 50 billion growth plan.
So you have very dedicated plans to put a lot of capacity for renewables also on the ground here in Germany. So how concerned are you about this not in my backyard problem?
I'm not so much concerned, I'm more hopeful, because the next German government needs to tackle and needs to address this topic. Everybody wants to go green, everybody wants to keep the wells and our jobs here, but nobody wants that something is built next to his house. And I think this debate needs to happen, because if that is not allowed or not accepted, then we implicitly de-industrialize. And I think when that is transparent, discussed with the people, they will accept it. And of course, it's also up to the government to define where investments are possible. We have done a lot of infrastructure investments in Germany in the last decades. So I think if somebody addresses it, it will be possible.
Let's talk a bit more about Germany, because clearly Germany faces an outstanding problem with exiting coal and nuclear. So how concerned are you about energy security, given our high intensive energy industry?
Yeah, Germany is still a very industrialized country, as you said, so there's a very high need for energy. But Germany has also a very good location, because the energy supply infrastructure is there. We have a very good pipeline system, import capacities. And in the long run, that will all be used for green energy, right? So we can use the existing infrastructure for green energy, but we need to do everything to build renewable energy sources here in Germany.
So if you look at the share price development, it's kind of telling, because year to date, the shares are even down slightly, or perhaps now flatlining after yesterday's surge. But still, I think the focus is the outlook for the business. And Mr. Kreber was also pointing out in another part of that interview that he thinks that renewables doesn't mean lower profitability, and that going forward, RWE will be in a very good position also when it comes to the comparison to other competitors. But there will be a transitionary period in which also energy prices can actually maintain at, or perhaps stick at elevated levels, because clearly the markets need to find a new balance. So perhaps inflation here to stay, at least if you listen to what the utilities are saying.
Annette, a really interesting interview. Thank you for bringing it to us and breaking down what's happening at RWE. We're going to take a quick break now. Coming up on Street Signs, U.S. President Joe Biden holds his first direct talks with his Chinese counterpart Xi Jinping, as the pair look to de-escalate tensions on a number of hot-button issues. We'll discuss next.
الأخبار؟ ألو؟ أيوة سامع. الصوت راح بس. ايوه ازاي؟ الحمد لله. الحمد لله. ايه الاخبار؟
Welcome back to Straight Science, everybody. I'm Juliana Tattlebaum, and these are your headlines. The International Energy Agency signals a reprieve from the crude price rally could be on the horizon as the group forecasts further growth in supply to round out the year. The Dutch government reportedly launches a last-ditch attempt to keep Shell in the country after the oil major announced plans to shift its tax base to the UK and end its dual share structure. Tesla shares are called lower, continuing a decline that saw its market value dip below $1 trillion as CEO Elon Musk sells more shares. U.S. President Joe Biden warns relations with China should not veer into conflict, holding his first official talks with President Xi Jinping, who calls for win-win cooperation.
It seems to me we need to establish some common sense guardrails to be clear and honest where we disagree and work together where interests intersect, especially on global issues like climate change.
So, Presidents Joe Biden and Xi Jinping have held the first direct talks between the superpowers since the administration in the U.S. took office. The virtual summit, which lasted just under 2 hours, saw both heads of state call for cooperation and the implementation of measures to avoid conflict. The leaders discussed some hot-button issues, including Taiwan, with President Xi urging Biden to maintain its acknowledgement of the One China policy. On trade, Biden stressed he would protect American workers from unfair economic practices. Biden stressed the need to set ground rules and improve communication.
It seems to me we need to establish some common sense guardrails to be clear and honest where we disagree and work together where interests intersect, especially on vital global issues like climate change. Our bilateral relationship evolves, seems to me to will have a profound impact not only on our countries, but quite frankly, the rest of the world.
Meanwhile, the Chinese premier stressed the need to avoid playing zero-sum games and that Earth is a, quote, global village, big enough for the development of both superpowers.
As the world's two largest economies and permanent members of the UN Security Council, China and the US need to increase communication and cooperation. Each run their domestic affairs well and, at the same time, shoulder their share of international responsibilities and work together to advance the noble cause of world peace and development.
We've got a fresh line on Nord Stream 2 that I want to bring you because it is potentially very significant. The German energy regulator is saying that Nord Stream 2's certification process is being suspended until such time that its operating company arranges German company status compliant with national law. And we've all been waiting for this certification process to see what the German regulator decides to do. Of course, remember Sylvia being out right where Nord Stream 2 breaks into Germany, and now we're hearing from the German energy regulator that that certification process is being suspended. They are saying the reason for the suspension, it needs the operating company to arrange German company status compliant with national law. We don't have any further information at the time, but certainly imminent approval or certification of Nord Stream 2 seems out of reach for now. No indication as to how long the suspension will last or how long it will take for the operating company to arrange this company status. But for now, the Nord Stream 2 certification process suspended. All right. Now, 2022 will be a year in which the world starts to spin differently. That's according to Control Risk's latest risk map report. The consultancy firm has looked ahead to the top global political, security, operational, and cyber threats as the world continues to recover from COVID-19. Charles Hecker joins me now, Global Research Director at Control Risk. Charles, great to speak with you once again. I look forward to these reports that you published, really comprehensive, interesting look ahead to the future. And this one certainly delivers on the wow factor. 2022, a year when the world starts to spin differently, a year when a new global geopolitical order will emerge. Sounds like a lot is in store for 2022. What is going to shape this new geopolitical order? Obviously, we're all watching the impact, the fallout from the U.S. retreat from the world stage under President Trump and now Joe Biden working hard to restore credibility at the international level. We're all watching to see what China really wants to do. So how do you see things shaking out in what you call the grand geopolitical repositioning?
That's right. Good morning, Juliana. It's great to be here. Thanks very much for the invitation. The geopolitical environment is always in a constant state of evolution, and I think companies are accustomed to that. But I think what's going to happen in 2022 is that this evolution is really going to change into a much more rapid and perhaps directionless transformation and repositioning. And you're right to mention Afghanistan. It really was the U.S. withdrawal from Afghanistan earlier this year that set this process finally and conclusively in motion, because it looks like really for the first time in a very long time, we may have a world without a global sheriff. And that was always the United States. And beyond just the sheriff role, the geopolitical environment, the terms and conditions of the geopolitical environment, the T's and C's that companies rely on, were pretty much always written by the US. And we just don't think that's going to be the case anymore. And we're still not sure who will write those new T's and C's.
It is a fascinating time, and it does feel like we're at an inflection point, and it is difficult to understand what China's ambitions really are. On the topic of China and the U.S., Taiwan, obviously a major geopolitical question mark, and tensions have been ratcheting up in recent weeks and months. China has been ramping up military activity around Taiwan. How do you think about the risk that China actually does initiate near-term military action on the island? How would you characterize that possibility?
I think it's time to take a little bit of the heat and a little bit of the emotion out of the equation here. The risk of any sort of intentional military conflict over Taiwan right now is very, very low. The greater risk really is an accident, a miscalculation, some sort of unintended impact over China. But, you saw Xi Jinping and President Joe Biden talk yesterday. These two parties are settled in for a very long-term strategic rivalry. And as the president said, President Biden said, competition, not conflict. And I think that shows you the mindset of the two leaders, which is not focused on short-term conflict, but rather on a longer-term strategic competition. And I think that companies, especially in 2022, we get asked all the time about the likelihood of a conflict over Taiwan. And companies that are focused on that, we think are really focusing on the wrong things. And that you're much more likely, or you should probably be more concerned about your compliance program in China. That's a higher likelihood event than conflict over Taiwan.
Interesting, the comparison there, putting it into context. So not something that businesses should prioritize as a near-term risk. Just to round out the geopolitical discussion, Belarus firmly in the headlines over the last few weeks with the escalating conflict at the border, with Russia entering the mix, the EU. How important is this, and does this constitute a key flashpoint that investors and market participants need to be watching out for?
Yeah, exactly. This is another one of these tests of the global geopolitical system, this new sort of unmoored system for 2022. I think that the near-term trajectory of this conflict is going to be contained. And what we're going to see, and this was announced yesterday, we're waiting for some of the details, you're going to see an escalation in the EU and the US's sanctions regime against Belarus. This is a flashpoint. Again, there is the possibility of a miscalculation. There's a possibility of an accidental escalation. But if this gets any hotter, and if you start to see involvement of NATO or any sort of broader talk of the military, I think you'll both see President Putin probably and President Biden come in here and try to negotiate a settlement before this gets totally out of control.
All right, Charles, let's turn to cyber risk. Your survey indicates that 80% of respondents agree that cyber threat landscape will be significantly worse in 2022 than it was in 2021. Huge impact not only for businesses, but governments, security more broadly. How do we manage cyber risk?
So here's the message for companies in 2022, and this kind of underpins all of the risks that we're talking about in RiskMap, but particularly on cyber. The message for companies for next year is you're on your own. Governments can no longer protect companies the way companies would want to or expect to. We anticipate that governments will be able to push back on the world's most important cyber threat actors. And right now, the attack surface, just the sheer volume of places that can be attacked by cyber threat actors, and the cooperation between state actors and criminal actors now has accelerated so much that governments themselves are really having difficulty keeping track and keeping up. And that means if you're a company that wants to keep your cyberspace safe, you're going to have to do it yourself.
Well, Charles, I just want to finish up the conversation on the political front. When we've spoken in the past, we've talked about the polarization that we have observed in many countries, especially in the developed world. We've got some key elections coming up in France, most notably here in Europe. How has the risks from the risk from polarization on the political front and radicalization evolved from recent years? Are things getting better or worse on that front?
Yeah, I'm a little bit on the pessimistic side, I think, on that one. And we've seen a real growth in state fragility as a result of the pandemic and as a result of the economic recession that we're only beginning to sort of climb back out of. States are under pressure, and we're going to see that precisely in the French elections. I mean, I think we're forecasting that Macron will probably emerge victorious, but he'll emerge weakened. And that is because the entire state structure, not only in places where we're accustomed to seeing this, like in the global south, but also in the global north, there's a real increase in institutional instability as a result of the pandemic, as a result of the polarization that you mentioned. And a lot of the outcomes are less certain than they used to be.
Charles, fascinating discussion. Thank you for setting us up for 2022. Charles Hecker, Global Research Director at Control Risks. All right, let's come back to Nord Stream 2. I mentioned just before Charles and I got into the conversation, the news that the German energy regulator has said the certification process for Nord Stream 2 has been suspended until such a time that its operating company arranges a German company status compliant with national law. Now we have a little bit more detail. So the German energy regulator is saying that currently Nord Stream 2 consortium has planned to just form a German subsidiary for the German territory of the pipeline. That is not sufficient. So once Nord Stream 2 has completed the necessary legal shifts, the regulator can continue with the remainder of currently applying 4-month period, within the remainder of the currently applying 4-month period. So putting a bit of a timeline on this process, saying that the regulator can continue within the remainder of currently applying 4-month period. So we have a little bit of a timeline here, and it seems as though the German energy regulator putting things in the hands of Nord Stream 2 in terms of whether or not they can move forward with the certification process. Obviously, Nord Stream 2 does play a role in the gas supply situation in Europe, with President Putin arguing that if the certification goes ahead, then it will ease the energy crunch that is happening in Europe right now. Obviously, the fact that it has been suspended will keep pressure on energy supply in Europe. And so this is one to watch, the German energy regulator announcing a suspension of the certification process. It is expected to be temporary at this stage, but of course, it all comes down to the company arranging German company status compliant with national law. What they have done so far, not sufficient, according to the German energy regulator. So we've been waiting for this news. It has now come through. You can see there we've got Dutch wholesale gas prices up about 9% on the session, UK wholesale prices up about 2%, and over in the US also moving higher on the back of the move higher in European natural gas prices. All right, let's leave that conversation there and take a quick break, because coming up, we've got retail earnings in focus. Walmart is set to post its third quarter earnings later today, and the first of a slew of retail results out this week. We'll discuss what to look for after the break.
اشوف هعملها ازاي. مفيش حاجة عاجباك في الراجل ده. بتقول ايه؟
Elon Musk's share sale has continued into its second week. The billionaire has sold another $930 million in Tesla shares to cover tax obligations stemming from the exercise of stock options. Musk had exercised options on Monday to buy over 2 million shares at $6.24 each, and so was required to pay income tax on the difference between the exercise price and the fair market value. Musk sold just under $7 billion worth last week, and it has been weighing on the stock. Currently, the early indication, Tesla shares down about 1.9% in pre-market trade. Meanwhile, Tesla is being sued by JP Morgan for more than $160 million. The bank is alleging a breach of contract over stock warrants, which expired this year, saying the warrants obliged Tesla to deliver shares or cash if its stock was worth more than the strike price at the time of expiry. JP Morgan repriced the options twice after Musk was sued for fraud by the SEC in 2018. Tesla is yet to comment. Warren Buffett's Berkshire Hathaway bought more than 13 million shares in Royalty Pharma in the third quarter, as well as Floor & Decor, while cutting its stakes in drug stocks such as Merck, according to a new 13F regulatory filing. Berkshire also reduced its positions in MasterCard and Visa. Walmart will headline a series of U.S. retail earnings due this week when it reports its third quarter results later today. Attention will be on how the big box retailer is managing global supply bottlenecks and inflationary cost pressures. CNBC.com's Melissa Repko joins us with a preview. Melissa, good morning.
Good morning. Yes, Walmart's expected to offer some early clues about how the holiday season is shaping up. Analysts anticipate that its revenue will be roughly in line with a year ago, and its earnings will be up slightly, about 4%. But above all, people will be listening to hear how Walmart's navigating challenges like congested ports and higher labor costs in this unusual environment. Compared to its peers, Walmart's may be better able to navigate those challenges because of its size and scale, which has allowed it to do things like negotiate prices with suppliers or have dedicated ships bring in goods from across the world and navigate through those congested ports. We'll also be listening to see if consumers are actually shopping for gifts earlier because of concerns about out of stocks and shipping delays.
A lot to look out for, Melissa. And Walmart, it sounds as though not immune to the supply chain bottlenecks and inflationary pressures that we're seeing across various sectors. Melissa, thanks for setting the scene. Melissa Repko, CNBC.com. I also want to flag that our colleague stateside will be speaking exclusively to Walmart CEO and President Douglas McMillon. Don't miss that interview at 15:15 CET. All right, back here in Europe, this is the picture for the European trading session. We've got a mixed picture, but overall, the Stoxx 600 trading about 0.2% higher. So extending the recent gains. Yesterday, the Stoxx 600 rallied about 0.3% to a fresh all-time high, marking the 12th positive session in the last 13. It was also a particularly solid session for German and French markets. On that note, let's take a look at how they're trading this morning. Both of those bourses hit fresh all-time highs yesterday. This morning, we've got the DAX up about 0.25%, similar gains for the CAC 40. And now the FTSE MIB has turned positive as well, trading about 6 basis points higher. The only outlier right now, FTSE 100 here in the UK, is trading below the flat line, but only about 7 basis points or so fairly contained moves. In terms of Forex markets, this is the picture for currencies. The dollar index gaining ground about 12 basis points higher to 95. The euro trading slightly on the back foot. Well, we've got some strength in sterling this morning, and that is perhaps what's weighing on the FTSE 100, that inverse relationship front and center this morning. So sterling trading about 0.4% higher versus the greenback at 134.66. U.S. futures, this is the picture for Wall Street. We've got a very muted start indicated at this stage. No major change for the S&P, the Dow, or the NASDAQ, mirroring the moves we saw yesterday. None of those indices made much of a move yesterday. All ended basically flat on the day. Interestingly, though, we did see defensive stocks outperform. Utilities rose about 1.3% yesterday, outpacing the rest of the U.S. market. We'll see if that trend continues today. But that's it for today's show. I'm Juliana Tattlebaum. Worldwide Exchange is coming your way next.
خلاص انا هقعد الف في الحاجات دي لو لقيت حاجه هبقى اختار. ماشي ماشي اهو الراجل جايب لك كل الحاجات اهو بس الماستر عايز تظبطه ازاي؟ هحطه على الديمو ونشوف هيعمل ايه. يخرب عقله بيجيب الحاجات دي كلها منين الراجل ده؟ طب ودوت شفت انت ده؟ هو ده اسمه ايه ده؟ سنايبر ترند. هو بيحط الصورة وبعدين الوصف ولا الوصف الأول بعدين الصورة؟ انت بصيت على ده؟ اللي هبعت لك الصورة في بتاع كده شكله كويس. بص هبعت لك الصورة، دور عليه ده شوفه كويس ولا لا. لا الصورة بتاعته تقريبا
It is 5 a.m. at CNBC Global Headquarters, and here is your top 5 at 5. Biden and Xi meet one-on-one in a virtual summit in the face of rising tensions over trade, COVID, Taiwan, and human rights. Crypto is crashing this morning as one CEO says his company is just weeks away from accepting certain coins as payment for services. FedWatch 2021 may be over as senior administration officials reportedly say a nomination for the new Fed head is imminent. Trouble for Tesla as a major bank takes issue with Elon Musk and his often rogue Twitter account. And getting ready for retail as Walmart reports results before the opening bell today. It is Tuesday, November 16, 2021, and you are watching Worldwide Exchange right here on CNBC. Good morning to you. I am Dominic Chu in for Brian Sullivan this morning, kicking off your Tuesday with U.S. stock equity index futures looking towards at least a little bit, you can see there, of stability at the opening bell. The Dow is going to be opened up a modest 10 points if these few moves hold into the opening bell right now. The S&P 500 down by less than 1 point and the NASDAQ down by 3. So all told, very, very stable. Now, turning to crypto, where it's not the case, red across the board as Bitcoin closes in on the 60,000 mark. Remember, it was 66, 68,000 earlier just in the last couple of weeks. Bitcoin right now down 6%, 60,106 the last trade there. Ripple prices, Ether, Litecoin, among many of the altcoins and what other cryptocurrencies that are now down on the day. Ripple, by the way, and Ether is now 42.21, down 7.5%. Also watching physical gold prices, hovering near 5-month highs. Right now, COMEX gold futures up 0.5%, 1875 spot 80 the last trade there. We are still down 1% on a year-to-date basis. However, you can see over the last couple of months here, we've seen a move higher amid some of those inflation concerns in the macro markets. And on to the move in the oil market after the IEA's latest report out this morning. You can see here crude oil for U.S. benchmark futures, $81.42, up 0.2%. ICE world benchmark Brent crude futures up about 0.75%, $82.69. Now, they're saying that the supply and demand balance in the global oil market could be about to ease. It expects output to rise by 1.5 million barrels a day in the remainder of this year, 2021. Well, around the world, it's a mixed picture overnight. With the Asian trade, you can see they're mixed somewhat. The Nikkei in Japan up about 0.1%. The Hang Seng in Hong Kong up about 1.25% on perhaps some of the optimism about that Biden-Xi virtual summit. The Shanghai Composite down about 1/3% as well. Now, Europe is just getting its trading day started a little bit there on the more positive side of things. We'll spin that globe around. The German DAX up about 0.25%, just about flat for the FTSE 100 in the UK, and the CAC in France up about 0.25% as well. Well, to this morning's top story, President Biden and China's President Xi Jinping meeting face-to-face, albeit virtually, for the first time since Biden took office back in January. The meeting coming amid rising tensions between the two countries when it comes to things like trade, human rights, Taiwan, the origins of the COVID-19 pandemic, and much more.
Our responsibility as leaders of China and the United States to ensure that the competition between our countries does not veer into conflict, whether intended or unintended.
I stand ready to work with you, Mr. President, to build consensus, take active steps, and move China-US relations forward in a positive direction.
Eunice Yoon joins us now from Beijing with the latest there. Now, Eunice, if you take a look at the virtual meeting, the key takeaways, what was the most forceful part of this virtual summit between those two world leaders?
Well, I thought it was interesting that both sides have been very, very positive in describing the conversation after the event. So the a U.S. senior administration official had described it as respectful, straightforward, open. China had also very similar language, saying that it's constructive, substantive. The event itself lasted 3.5 hours, so a lot longer than people had expected, which was also seen as a positive sign. And also they talked about a wide range of issues, no major breakthroughs, but still they covered a lot of ground, including human rights, the pandemic, as well as climate change. Now, the big issue, as expected, was Taiwan. Biden reaffirmed the U.S.'s longstanding one China policy and the commitment there that Taiwan is part of China. He expressed concern, though, according to the U.S. official, of Beijing's behavior. Taiwan, as well as the U.S., has seen Beijing's recent aggressive action, or at least they believe it's aggressive action in terms of like military incursions, flying squadrons of jets up towards the cross straits, and that has been creating a lot of tensions. China's version, though, has been to focus more on that Biden said that the U.S. does not support Taiwan independence, and also that President Xi was doing a little bit finger wagging to Biden, warning of drastic action if any forces were to cross the red line, according to Beijing. Now, in terms of business, there wasn't a whole lot that was where we saw progress. But Biden, according to the U.S., said that China should fulfill its phase one trade deal commitments. China, though, did not mention the phase one trade deal in its readout. Instead, it was showing how President Xi was much more critical of what it described as the U.S.'s moves to suppress Chinese firms and the spillover effect of U.S. macroeconomic policy. And then one positive thing, though, Dom, that came out of this on the business side is that China said it's going to upgrade a fast track lane for U.S. business travelers. So make it a little bit easier for the U.S. and China to do business. So that is a positive sign.
Eunice, it's a 3-hour virtual summit. You went through what seems like a laundry list of all kinds of topics that they talked about. I'm curious then, what was left off the table? What did they not address during this 3-hour virtual summit between Biden and Xi?
Well, I think the biggest one was the Olympics, because there was some anticipation and questioning as to whether or not President Xi could potentially invite President Biden at this event to come to the Beijing Olympics, but that was left off the agenda. And some of my sources in the diplomatic corps have actually said that there was a little bit of concern that this could create a bit of a problem because President Xi has been a little bit nervous about the COVID-19 situation, or at least a lot of the people around him have been concerned about inviting any state leaders, in fact, to come to China for that event. And then it's kind of hard to figure out how you get around the handshake, since there's a protocol. If state leaders come in, then you got to do the whole handshake thing, and that might not be so easy to do if you're worried about getting COVID.
Of course not. The theater, of course, is going to be huge there in Beijing. The question is whether or not those leaders get involved. Eunice Yoon in Beijing, thank you very much for the update on that big virtual summit between Biden and Xi. Well, let's get to some of this morning's other top headlines right now. Silvana Henao is here with those. Good morning, Silvana.
Hey, Dom, good morning. Shares of Lucid moving higher in the pre-market after reporting its first quarter results as a public traded company. The EV startup announcing a notable increase in vehicle reservations and confirmed its production target for next year, while reporting a net loss of $524.4 million in the third quarter. Lucid, which went public via a SPAC deal back in July, reported it has lost $1.5 billion through the first 9 months of the year. The company says it has more than 17,000 reservations for its Air sedan, up 13,000 through the third quarter. The reservations through September represented an order book of $1.3 billion, according to the company. Elon Musk continues to unload Tesla stock, exercising his options and selling another 930 million shares yesterday after dumping $6.9 billion in stock last week. That's according to filings. Musk sold more than 934,000 shares yesterday at prices ranging from $625 to $1,028 a share. In total, Musk has sold about 7.2 million shares for about $7.83 billion since November 8th, a day after Musk's Twitter poll decided he should sell 10% of his Tesla stake. And Epic Games CEO Tim Sweeney renewing his attacks on the power of big tech, namely Apple and Google. Speaking at a conference in Seoul overnight, Sweeney said Apple complies with oppressive foreign laws which surveil users and deprive them of political rights, but at the same time is ignoring anti-competitive laws passed by South Korea's democracy. Apple must be stopped. Dom?
All right, Silvana Henao, thank you very much for those headlines. When we come back on the show, earnings season rolls on with big box retailers taking center stage, the names you should be watching coming up ahead. Plus the great lengths some companies are going through to get their products from port A to port B. And then later on, much more on last night's summit between Presidents Biden and Xi. The key investors' takeaways are coming up ahead, where Worldwide Exchange returns after this break. Welcome back to Worldwide Exchange. Stocks in a holding pattern this morning as investors gear up for a busy day with retail on the brain. October retail sales figures are out in just about a few hours now, along with earnings from the likes of Walmart and Home Depot and others, kicking off a slew of results from the big box stores this week. Now let's bring in Delano Saporu for more on what's happening with the markets right now. Delano, great to have you with us this morning. Let's talk about whether or not a market at record highs, like it's been for the better part of this year, still is worthy of investing in, or should you be taking profits?
Thanks, Tom, for having me on. I think that's a great question. My big focus right now is the consumer. As you mentioned, we're having a big slew of earnings from some of the big retail companies. But if you look at the consumer, the biggest focus has been on inflation, right? And we saw that inflation has scared a little bit of consumers in the sense of consumer sentiment for the Michigan index dropped for the last time for what we've seen in a little bit. And so when I'm looking at the consumer, I'm also looking at what they're willing to spend. As you mentioned, the retail print is coming out, and that's a big focus. I'm still on the bullish side. I do believe consumers are willing to spend. If you're looking at some of the metrics that are showing that, especially when you look at the MasterCard print that they're showing, that consumers are anticipated to spend more than they've spent in a while. I do think you could put fresh cash to work, especially in areas when they're looking at some of the e-commerce plays on the retail side, Dom.
So what part of the spectrum, when we talk about the consumer, generally speaking, the U.S. consumer is the healthiest it's been in years. Their balance sheets have been delevered. They're paying off debt. They've got more money coming in from government payments over the course of the past year. What part of the retail spectrum does that benefit? What types of companies will stand out this earnings season?
I think there'll be a few, and I think I'm focusing more on the e-commerce place. So if you're looking at Shopify, you're looking at a place obviously that's a big box but has a great e-commerce strategy, which is Target. You're looking at Amazon as well. And if you look at the past month, obviously the S&P 500 has done about 5% over the past month, but consumer discretionary has performed the best. That sector's performed the best at about 6%, and tech coming in right behind that. So I'm looking at merging those kind of plays and looking into the more e-commerce strategy. Look at Overstock, over 40% in the past month. So those are the plays we've been adding fresh cash to, and we'll continue. Obviously, you have a barbell strategy and maintain your areas that may be defensive, but if you're looking for an area to still look for growth, I think this is a great play right now, Dom.
Many of those names that you mentioned are volatile. Maybe not as much, say, Amazon, but say names like Shopify, other e-commerce plays have been volatile, not just around earnings season, but just in general. Do you expect that volatility to play out during this earnings season as well for some of these names as they kind of develop more in the coming weeks with investors?
Yeah, 100%. One, as we mentioned, we don't know how much is priced in. There may be some of that sentiment that we mentioned already priced in. I know there is, but how much of that is priced in is still yet to be seen. So over the near term, there'll definitely be volatility. And I think that might present opportunities for investors that are looking at these companies and some of these trends over the long term. You guys have talked about a lot of the great resignation, which may play into part in obviously folks moving to other jobs, but also starting their own businesses, which also plays for a company like Shopify, which is a long-term trend that we'll probably continue to see. So I do think in the near term you will see volatility, but may present opportunities for some investors.
Delano Saporu at New Street Advisors, thank you very much for your thoughts this morning. We appreciate it.
Thank you, Dom.
Still on deck for the show, CNBC goes whale watching as some of the biggest names in the business report their latest trades and holdings. Find out what Warren Buffett, David Tepper, and more did with their cash over the last 3 months.
Today's big number, $13,295. That's how much it cost to ship a container from China to the West Coast last week, according to the Freightos Baltic Index. That's down 26% from the prior week, but still nearly triple the cost from a year ago.
Time now for your big money movers, and today we are focusing on the quarterly 13F filings by some of the world's biggest and most well-known investors. Let's start with Warren Buffett and Berkshire Hathaway, the firm shedding its stake in Merck in the third quarter and reduced its holdings in other drug makers as well. Berkshire disclosing new positions, though, in Royalty Pharma, which buys drug royalties, and flooring retailer Floor & Decor. Those shares, you can see they're mixed in the pre-market trade. Appaloosa, which is run by Carolina Panthers owner David Tepper, sold its stake in Netflix last quarter. The firm also cutting its stake in Amazon by 44% and Micron by more than half. Some of those stocks a little active in the pre-market trade as well. At the same time, Tepper is making a big bet on retail. Appaloosa increasing its stake in Macy's by more than 90% to 7 million shares. And finally, Michael Burry of the Big Short fame exited bearish bets on Tesla, Alphabet, and Cathie Wood's ARK Innovation Fund last quarter. That's according to SEC filings. Burry told CNBC last month he was no longer betting against Tesla, and his position was just a trade. As for his new investments, Burry added a long position in Lockheed Martin in the third quarter. Well, the container crisis is plaguing importers around the world. Some companies now are chartering vessels known as bulk carriers that would normally move commodities like coal and iron ore to move their products around. CNBC's Lorianne LaRocco joins me now with more on the logistical trends there. So, Lorianne, tell us more about these bulk carriers. We talk about them as Cape Maxes and Panamaxes. They move bulk commodities. They're now being converted to containers.
Yes and no. It's interesting because these bulk freight vessels carry flour, livestock, feed, soybeans. And so it's loosely and unpacked. But what we have found out and what's been reported on is that companies like, say, Coca-Cola, they are using, say, jugs of their liquid and putting it on a vessel, on a pallet. So some are using containers and some are not. And we have some great video from the Port of Virginia who is seeing bulk items come in. And they tell me it's a faster alternative to go break bulk because those terminals avoid the container congestion. They're less busy. And also time is money. And remember, a vessel at rest is a vessel that is not making money and you need to get your product out.
Okay, so then, Lorianne, what types of items are on these vessels now? And are they coming into all ports or just certain ones on certain parts of the coast, west or east in the U.S.?
They're coming into a variety of ports, Dom. For example, I spoke with the Port of Baltimore. The head there is Bill Doyle, and he told me they've received 136 containers full of Bitcoin computer servers for the Bitcoin mining company, Valaresh. These recently came in. And Import Genius said $30,000 per unit. And so that's a total of $4 million. You also have tractor trailers coming in on what's called roll-on, roll-offs. And so what that means is that you literally drive the tractor right onto the vessel as you would a car. And then Coca-Cola, as I said, uses the raw ingredients on a pallet. And then here's something really telling. When you're looking at Port Houston, they recently showed Amazon containers, and they did indeed put 53-foot containers on this break bulk vessel. But when you looked through the bills of lading using Import Genius, half of those containers were empty. And so that tells you, Dom, they're getting these containers in so they could put them either on railroads or on trucks so they can move the product.
All right, so you also mentioned the number of idle ships, the number of vessels at anchor are increasing as well. What can actually help alleviate some of the congestion, the traffic coming with many of these ports?
The two big things that I'm hearing repeatedly, both from the chassis side and the truck side, are they're restrictions. You've got empty container restrictions, which is handed down by the ocean carriers. They tell the terminals what type of container they are allowed to pick up that day. So if they only want a blue container, but you have a pink one, you can't deliver it, and that container is stuck on your chassis. And then you also have what's called a chassis restriction. This, again, is something that the ocean carriers have dictated with a certain amount of drayage truck providers. And those are the trucks that go in and out of the port. They tell the drayage driver what chassis is allowed to pick up what containers. So those two restrictions really hogtie the trucking industry in moving stuff.
All right, so there's a lot of dynamics in play there right now on the shipping side of things. Lorianne Laraco of CNBC, thank you very much. We appreciate it. Let's get a check on this morning's other top headlines as well. NBC's Philip Mena is in New York with the latest there. Good morning, Philip.
Hi, Dom. Good morning. The jury is set to begin deliberations today in Kyle Rittenhouse's murder trial. He shot and killed 2 men and wounded a third during unrest in Kenosha, Wisconsin last August. Prosecutors argue that he was out looking for trouble, while the defense says he was ambushed and had no choice but to use his weapon. Rittenhouse faces 5 felony counts, including intentional homicide. U.S. officials are condemning a Russian weapons test in space, which they say forced astronauts and Russian cosmonauts aboard the International Space Station to seek shelter. The State Department confirmed a missile destroying an old Russian satellite caused the space junk to scatter. Officials say more than 1,500 pieces of the trackable debris were created by that test. Secretary of State Antony Blinken called the missile test reckless and said that it created debris that risked the interests of all nations. Experts say an atmospheric river is bringing widespread flooding to the Northwest. More than 70,000 customers in Washington are still without power as rivers crested to record high levels. 2 landslides near the city of Bellingham block part of the Interstate 5 highway. And finally this morning, New Yorkers may be ringing in 2022 in person this year. In a daily press briefing, Mayor Bill de Blasio hinted that a large and wonderful crowd is expected to return to Times Square for New Year's Eve. This past year, which was mostly virtual, was the first annual New Year's event without a massive turnout. That's it from here. Dom, back to you.
Philip, I got to say, as a resident of the New York metro area, to me, it will signal the end of the pandemic if we start to see people in Times Square for the ball drop on New Year's Eve. I don't know how you feel about it.
I mean, upwards of 1 million people. And as cool as it looks on TV, I'd like to leave it at just that. I could not be down there. Lack of bathrooms, too many people. Even before this pandemic, it was just too much.
And cold as well for some of those days. Philip Mena, thank you very much. Have a nice day, sir.
All right, you too.
Straight ahead on the show, could the end of the Powell-led Fed be near? What lawmakers close to the decision-making process are saying about Biden's next pick to lead America's central bank. We'll be right back after this. calling for more cooperation. President Biden and China's President Xi Jinping virtually coming face to face as the pair look to cool simmering tensions between the two superpowers. Crypto is facing a broad dip this morning with Bitcoin falling back towards the 60,000 threshold and owning a piece of the pack. Green Bay looks to let cheeseheads get in on the action and invest in the team. It is Tuesday, November 16th, and you are watching Worldwide Exchange right here on CNBC. Welcome back to the show. I am Dominic Chu in for Brian Sullivan today on Worldwide Exchange. Here is how your money and investments are looking halfway through the 5 a.m. Eastern Time hour. Futures, we will call them stable right now. The Dow is implied lower by only about 8 points. The S&P down by about 4 points. And the NASDAQ implied lower by 24. Stocks now tracing a slight dip to kick off the new trading week with inflation fears continuing to linger over investors. Also take a look at the bond market right now. The 10-year benchmark U.S. Treasury note yield climbing back above 1.6% yesterday. Right now, though, ticking just slightly lower, holding right steady at that 1.6.0 mark there. The 2-year Treasury note yield 52 basis points or 0.52%, and the 30-year long bond 1.98% the last trade there. Checking on cryptocurrencies, a broad drop this morning. Bitcoin moving below that 60,000 threshold. Right now, those particular prices are 59,261 for Bitcoin, off 7%. Ether prices down 8.5%, 41.79 the last trade there. Now, the move's coming amid comments by China's state planner today that it will continue to clean up virtual currency mining in the country. Now to this morning's top stories. Silvana Henao is back with those. Good morning, Silvana.
Hey, Dom. Good morning. So, Dom, President Biden's decision on the next Federal Reserve chairman appears to be nearing. According to Bloomberg, Senate Banking Chairman Sherrod Brown says he's been told by White House officials that an announcement on the matter was, quote, imminent. Bloomberg adding, however, that another official stressed the president's decision might not be as soon as Brown believed. Biden is expected to name his pick before Thanksgiving. Current chair Jerome Powell's term ends in February. The president met with him and fellow frontrunner Fed Governor Lael Brainerd about the job earlier this month. JP Morgan is suing Tesla, claiming the electric automaker owes the bank $162 million. The bank says the payment stems from a 2014 stock warrant agreement. The issue centers around adjustments the company's made to the agreement following Tesla CEO Elon Musk's 2018 tweet that he was considering taking the company private and the resulting fallout. And ExxonMobil reportedly launching a sale of its oil and gas properties in Texas. According to Reuters, the oil giant is looking to unload its Barnett Shale holdings that include 2,700 wells across about 182,000 acres in North Texas. Reuters says the move is part of a portfolio reshuffling by Exxon to focus more on profitable assets. Dom, back to you.
Silvana, thank you very much for
Got
that.
it.
Back to this morning's top story. President Biden and China's Xi Jinping meeting face-to-face, albeit virtually, for the first time since Biden took office back in January. The meeting coming amid rising tensions between the two countries when it comes to things like trade, human rights, Taiwan, the origins of the COVID pandemic, and more as well.
As I've said before, it seems to me our responsibility as leaders of China and the United States to ensure that the competition between our countries does not veer into conflict, whether intended or unintended. And it seems to me we need to establish some common sense guardrails to be clear and honest where we disagree and work together where interests intersect, especially on vital global issues like climate change.
As the world's two largest economies and the permanent members of the UN Security Council, China and the United States need to increase communication and cooperation. I stand ready to work with you, Mr. President, to build consensus, take active steps, and move China-US relations forward in a positive direction.
All right, according to Chinese state media and senior U.S. administration officials, the two had extended discussions on Taiwan and human rights. Biden stressing the need to protect American workers from China's unfair trade and economic practices, while Xi says the U.S. should stop abusing the concept for national security to oppress Chinese companies. The Winter Olympics did not come up in the discussions, but what did was the creation of a so-called fast-track lane to bring U.S. business people back into China. For more on this and investor implications, let's bring in Longview Global Managing Director and Senior Policy Analyst Dewardrick McNeil. He's also a CNBC contributor. Dewardrick, thank you very much for joining us. Let's talk about whether or not the U.S. and China can actually move forward with some kind of constructive dialogue, given the fact that there are so many points of contention right now between our two countries.
Morning, Dom. Thanks for having me. Look, I think you hit the nail on the head. The real question, and this was a testable proposition, was whether or not the U.S. and China can find a way to cooperate where it's in their interest and compete where it may be not in their interest to do so. And we will see what happens going forward. This meeting was important, though, Dom, because it helped to reform and reframe habits of cooperation. But more importantly, Dom, it helped to establish habits of competition. And as you heard from the president, he was very clear that he thought the relationship needed some guardrails so it doesn't veer into conflict as we continue to address some of those difficult issues that you raised. But this meeting was not about solvency as much as it was about the Biden administration, at least, trying to set the terms of engagement and competition more in a way that reflects U.S. interests, U.S. values, and norms. There's been a belief here in Washington, at least, that the relationship has been more set in a way that benefits China and China's development to the detriment of the U.S. And the Biden administration has worked hard to try and change that narrative and change that approach to the relationship. But there's a lot of work to do going ahead, Dom. And what I'm looking to see is if there will be a management mechanism below the leader level, senior level, working level dialogue set up to do exactly what the two presidents suggested they wanted to do last night. And that's yet to be seen.
So I mean, there's been no doubt. I mean, both sides of the aisle, members of both sides of it, we understand that there have been some unfair things that China's done over the last couple of decades now, at least, with regard to trade practices. And President Trump, in his administration, attempted to address some of those things. Do you feel as though the Biden administration will continue some of those policies? If so, what does that do for tensions with China vis-a-vis things like human rights in Taiwan as well?
Yeah, good question, Dom. Look, I think that there's been some attempt, certainly by the Trump administration, to change the way in which China has engaged in trade. But I think if you're talking about the phase one deal, it fell short of what the expectations were when they launched a 301 investigation into China's trade behavior. None of the structural things were really addressed in that deal. And I suspect you will see the Biden administration at some point try and come back to some of those structural issues, state-owned enterprise subsidies and technology transfer issues. And I think that's going to cause some problems in the relationship, Dom. So I don't think we're out of the water yet with respect to trade. And then I think on Taiwan and human rights, those are areas where the interests are certainly misaligned. The Chinese were clear last night. They consider these things to be core to their sovereignty. And so we're in for a tough road ahead on those issues. But they were on the table last night. That's positive. We've talked about our differences on those issues, and it looks like we're still trying to move forward to form some type of cooperation in areas where we can. But this is going to be a challenge, Don.
It's going to be a challenge for sure. It's no easy solution with the two biggest superpowers and economies in the world. Dewardrick McNeil at Longview, thank you very much. We appreciate it.
Thank you, Don.
All right, coming up on the show, retail is in focus as Walmart and Home Depot gear up to kick off a very busy week for retail earnings reports. Jerome Martis previews what to watch in the numbers coming up next. But first, as we head out to break, some big money movers for you. Shares of Rackspace climbing higher after topping expectations with its third quarter results, while bookings for the period fell year over year. Company leaders revealed the cloud services firm had landed a large competitive deal early in the fourth quarter that promises to make up for the shortfall. Rackspace right now up 7% pre-market. Shares of Advanced Auto Parts dipping despite third quarter results topping expectations. The company stressing that it is seeing higher than planned inflation headwinds. Now, those shares as well. And then shares of Axon Enterprise are surging up 20%. The company's earnings of $1.17 per share blowing past analyst forecasts, while revenue also was a beat. You can see there those shares up 20% pre-market. Worldwide Exchange is back after this. Welcome back to Worldwide Exchange. Green Bay fans getting a chance to own a piece of the pack. A massive sweet treat just in time for the holiday get-togethers, and a popular crypto getting the green light at one movie theater chain. Silvana Henao is back with a look at this morning's top trending stories. Silvana.
Hey, Dom. All right, Dom. So let's start with the Green Bay Packers because they're giving fans a chance to own part of the team. The team has announced it will offer to sell $90 million of stock in the franchise. But to be clear, the stock will have no value, pay no dividend, and allow no say in team matters. The money will instead be used to help fund improvements at Lambeau Field. The offering marks the sixth time in Packers history they've offered shares to the public. Hershey's unveiling a massive sweet treat just in time for the holidays. The company's Reese's brand has released its largest peanut butter cup ever, clocking in at 9 inches in diameter, over 3 pounds, and 3,000 of these pies were up for grabs at around $45 each, but they quickly sold out. And at AMC's CEO announcing that the movie theater chain will start accepting Shiba Inu as a form of payment. Adam Aaron tweeting last night that it will take the crypto in the next 2 to 4 months. Last week, Aaron said AMC will start accepting Bitcoin, Ether, and other cryptos for online payments. Dom?
The one that's got me more curious right now, because I am such a fan of chocolate and peanut butter together, is the massive pies.
Right?
So would you bring it for, say, the holidays, bring it for Thanksgiving as a pie instead of the apple one or the pumpkin one?
Absolutely. And it's going to be a great talker, too. I mean, think about sitting around a table sharing that thing. That's going to be delicious.
I'm looking at that thinking to myself, I really want to have a peanut butter cup right now.
So good. It sounds so good.
Silvana, now, thank you very much for those
You
trending
got it,
stories.
Dom.
We appreciate it. Well, the big U.S. retailers will begin reporting third quarter results today, kicking off with Walmart and Home Depot before the opening bell. Walmart is expected to post a slight increase in sales as it benefits from early Christmas shopping, while it also deals with ongoing supply chain issues. Home Depot may be helped by demand from professional contractors for things like tools and building materials. Let's talk more about this and the state of the retail industry ahead of the holidays with Jerome Martis, Director of Consumer Research at Refinitiv. So, you know, it's funny. Jim Cramer was just out there tweeting that this is like a second earnings season. It is that important because consumer spending is such a big part of the U.S. economy. What are Walmart and Home Depot going to tell us about the state of the consumer?
Well, good morning, Don. It's going to be very telling about the state of the consumer, especially because of Walmart's proximity to the consumer. It's located within 10 miles of 90% of the U.S. population, also because of its size. Walmart, despite of its size and the pandemic and all the macroeconomic headlines, is expected and continues to post growth on the top and bottom line. And this is mainly because of its heavy investments in innovation, especially in the e-commerce, advertising, and healthcare businesses. On the other hand, Home Depot, they are still benefiting from the strength in the housing market right now, and also of the fact that consumers are still spending a lot of time at home compared to pre-pandemic times. When we look at the monthly retail sales data, we can also see that consumers are still renovating their homes. So they're still throwing a lot of money in there, especially because house prices are going up. So they prefer renovating as opposed to buying. And of course, the revival of the pro business is still benefiting Home Depot. So as a result, our Refinitiv data tells us that not only are we expected to see positive earnings and revenue growth from both these retailers, but we could also see a positive surprise.
So what's been perhaps a catalyst for many investors over the last several quarterly reports for both of these companies has been some of the online channels, the e-commerce that you were talking about. Is there still a keen focus on that, given the comparability issues that we are going to see? I mean, we know that the pandemic generated a lot of those online sales. Is it just going to be something where we know that as people get back to normal, those e-commerce sales may be tailing off just a little bit?
Well, e-commerce sales numbers are going to be very telling, right? Whether that trend is fading or the flight to online is permanent. Currently, the Refinitiv estimates for e-commerce in the United States is looking at double-digit growth for the third quarter, which is significantly stronger than the second quarter. So this is telling us that consumer spending online has picked up somewhat for the quarter, especially because holiday sales were moved even earlier in the year. And when we look at the individual retailers like Home Depot, Lowe's, Walmart, and Target, those numbers are actually suggesting that the business volume is holding up well, especially given that these four retailers saw such astronomical strength in e-commerce last year because of the omnichannels. Their omnichannel strength. So as a result, we can see that e-commerce numbers are going to be very significant, especially since there is no comparable year to 2020. Never before have retailers had to close their doors, and the online e-commerce numbers are going to tell us whether this trend is here to stay or not.
Jerome, we've got just a few moments left here before we let you go. Is it, in your research world, is there a place, a specific group of companies that you think will benefit the most during this specific holiday season coming up?
Well, definitely the discounters, because if anything, the latest consumer confidence numbers at Refinitiv are telling us consumers are very worried about inflation, which means this year they're going to be even more savvier to trying to find a best value and deals. And as a result, the discounters are going to be the one that are likely to benefit the most. The supply chain issues and inflation issues are here to stay into the holiday and even into 2022. But our Refinitiv data shows that no matter how the economy is faring, holiday season happens every year. And because of double-digit earnings growth for the fourth quarter, retailers will have another merry holiday season.
All right, it is seasonably strong for these retailers for sure. Jeroen Martis at Refinitiv, thank you very much. We appreciate it. On deck for the show, stocks continuing to face some pressure as inflation fears hang over investors. Emily Bowersock-Hill lays out how to navigate that uncertainty in the trading day ahead. That's coming up. Welcome back to Worldwide Exchange. Over the last several weeks, we've seen some interesting trends continue and also new developments in the marketplace that are worth noting. First of all, when it comes to the S&P 500, the white line is the performance of an ETF that tracks all S&P 500 companies and weights them equally. So you can see that's actually outperformed the traditional market cap weighted S&P 500, not by very much, but still a few percentage points. That particular trend means perhaps that there's a broadening out of the market, participation in more companies. That continues right now. We'll see if that helps the next leg of the market. Also, we've seen a new breakout to at least try to get to record highs for the small cap stock index. This particular ETF, the iShares Russell 2000, IWM is the ticker there. On a year-to-date basis, up 21%. You can see there, we've tried to make some moves to reclaim record high levels, and that iShares Russell 2000 could be a good sign, perhaps, if those small caps can continue to outperform. And then over the last 3 months, the momentum trade in the market has certainly been in the energy sector and the consumer discretionary sector. Perhaps no surprise there. This is a seasonally strong time, especially for retailers. Meanwhile, the utility sector, the worst performing one over the last 3 months, people not as enamored, I guess, with the defensive trade there and dividend paying stocks. So Leonard, let's bring in Emily Bowersock-Hill. She's the founding partner of Bowersock Capital Partners. Now, Emily, if you take a look at the way that things have developed right now, do you feel as though it's still constructive for the markets overall? Would you feel comfortable committing more capital to markets at these near record high levels?
That is a tough one. I do expect this rally to continue into the end of the year, but this is one of the times when individual investors actually have the power. And we're recommending to clients who have huge amounts of cash to deploy that cash gradually and to not feel pressured to chase these returns. Especially in US large cap growth stocks, stocks are overvalued by almost every measure. And that doesn't mean that with the huge amount of cash on the sidelines and with a very active retail investor that this couldn't continue for a while, but we're counseling patience.
So patience is a virtue, sometimes a necessity for many investors out there. If you look at the way it's developing right now, we haven't really seen a major pullback at all over the course of the last several months here, certainly since the pandemic lows that we saw in March of last year. Is there any kind of a pullback that you're looking to target for people to deploy that capital patiently, in your words?
At this point, where I would be happy with a pullback of 5% or more. And we saw that in September, right? We certainly haven't seen a real correction of 10% in a very long time. But what we're seeing every time we see a substantial, 4 or 5% correction is that retail volumes pour into the market. That's been a consistent pattern. So I do think part of the problem is that there are no alternatives out there, and you still have very active traders who became active during the pandemic, and and are just watching for an opportunity to put more money into the market.
So what's then on your shopping list then? If you're waiting for some of those pullbacks to happen, are there certain specific companies that you eye as being ones that you would pick up if they do drop in value by whatever that 5 to 10% mark that you're citing here?
Yes, absolutely. First of all, international developed market stocks are still trading at about a 30% discount to US stocks. But in terms of individual stocks, there's a subset of companies that IPO'd in 2020 that got caught up in the retail euphoria and shot up in price and then subsequently fell in half. And I would give you an example of Big Commerce, which is a small cap growth stock, part of that Russell 2000 that you were talking about previously. And it shot up to between $60 and $70 a share, now is trading in the 50s. And after its second quarter earnings, its sales actually surpassed expectations, but its loss per share missed. And so it dropped precipitously in price, and we picked up a lot of it. And then I think our expectations were proven out in its November 4th earnings. And, that company has been increasing revenue by 30% per quarter for 7 consecutive quarters. They've got a very disciplined management team. It's a Shopify competitor, but it's trading at around 20 times sales versus Shopify's 50 times sales. So that type of investment that's a disruptive growth stock, there are definitely still opportunities out there.
All right, opportunity hunting for sure. Emily Bowersock-Hill, thank you very much. Have a nice day.
Thank you.
All right, that does it for us here on Worldwide Exchange. Squawk Box picks up the market coverage coming up next with futures indicating, we'll call it a stable opening bell.
Good morning. Retail earnings are in focus. We're going to hear from Home Depot about same-store sales. Might be the smallest gain we've seen in a while. Also going to hear from Walmart in the next hour or so. We will bring you the numbers and the instant reaction and analysis. And Elon Musk selling another $930 million in Tesla shares yesterday. We'll take a closer look at his strategy, his tax strategy, now that he's a Texas resident. Plus, crypto prices plunging as everybody's writing articles on gold and its comeback. Bitcoin tumbling below $60,000. We'll show you what's moving right now. It's Tuesday, November 16th, 2021, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box here on CNBC. I'm Becky Quick along with Joe Kernan. Andrew is off today. Yesterday was a pretty non-existent day for equities, at least if you were looking at the end of the session, basically marching in place for the session. You were talking about the Dow down by 12 points, the NASDAQ off by 7 points, but the S&P was down by 0.05 points. So, yeah, basically standing in place for the day. This morning, it's more of the same. NASDAQ's off by about 17, but the S&P is only down by about 3. Dow is up only by about a half a point at this moment, and we are obviously awaiting all those earnings numbers. That could move the needle one direction or the other as we get a better look into the health of the consumer, but maybe more importantly into the margins of these companies that are reporting today, Home Depot and Walmart, whether they were able to maintain their margins given the huge prices that we've seen for producers. Could they pass it on to consumers? Could they find other ways to do it? We'll find out. Treasury yields this morning. Let's take a very quick look. You're going to see right now the 10-year is yielding 1.599%. So almost back to 1.6%. We'll see if it can push beyond that and even further higher. Overnight, as Joe mentioned, the price of cryptocurrencies plunging. No clear catalyst on this. Of course, we could say the same thing a lot of days that it's up. Maybe it's just that it's Tuesday. Bitcoin tumbling back near 60,000. Right now, you see it down at around those levels. You've also got Ether down as well. And some other major coins also falling pretty sharply. You can take a look across the board. Bitcoin off by 5.5% right now. Ether down by 6.5%. Litecoin off by 10.5%. It's the biggest decliner of that board. We'll continue to keep an eye on this, Joe.
Yeah. I used to know all the gold coins. I don't know about Krugerrands anymore. Maple Leafs. So I would say those coins are not falling today. And in fact, the 52-week high and low on gold was, I don't remember, it was as low as 1672, and it's been to 1962. Yeah. Gold. But
it's
the
still
last
like
month,
break even for the year.
Well, the last month it's up. And it's up from about 1750. And it reminds me of the size of the move. It reminds me of the 10, the 10 years back to 1.6 because of those inflation numbers last week. And we got a similar sort of a anticipatory move in gold and that you are seeing some effect there. And you can hear people thinking, transitory? Janet Yellen says it's transitory. Other people say, is it transitory? Is it in these small moves? It's almost like people are maybe setting themselves up for what might be more than just a transitory move in inflation.
Well, Larry Summers has had some really strong comments about this, too. I don't know if you saw what he said yesterday. He said, look, inflation is here. The Fed needs to act immediately and stop the purchases. And if they don't, inflation very likely is going to set it up so that Donald Trump comes right back in.
We'll see about Powell, too. Yesterday, there was some word that maybe some senators would be alerted pretty soon about what the decision was going to be. That's going to be near term. Geez, he gets pummeled by a lot of people and he seems, I don't know, we'll see. Woman as Fed chair.
Leo Brainerd, you mean?
Yeah. And not a Republican. And, Elizabeth Warren, Bernie Sanders. I was reading, there's a piece in the Journal today about, I love it, the nominee for control of the currency, which we've talked about a lot. The individual went to Moscow State University with Leisman. I think they were undergraduate. Steve did not go there.
Steve did not, no.
But Ms. Omarova did go there. And I don't know if you saw the Journal. It's kind of interesting. I was reading a piece in the Journal. In this case, it had to do with restructuring companies that are in the wrong business, and that the government really needs to be involved with what type of companies they end up. And the Journal points out, at least she's honest about what she would propose. But I don't know. What do you think? I mean, what do you give it for?
Look,
I would think Powell was a shoo-in, 95%, and I don't think it's 95%.
It's
I
not.
think it's
Yesterday,
about
I saw,
60.
Yeah, yesterday you saw an 8-cent move yesterday on the things that were predicting it. Yeah, on predicted, it was up 8 cents for Lael Brainerd, down 8 cents for Powell. It's closer to a 60-40 split.
I felt that. I didn't even look at predicted, but that's
And we'll see. Look, we've talked about this all along. How much of this is Biden going to feel like he has to appease progressives on this? How much of this is he going to feel like, I haven't given you on other things? This is part of the horse trading that takes place in politics.
Jay Powell
Politics definitely plays a role.
What more could I have done for you?
Yes.
How much more could I have done?
And the Treasury Secretary, Janet Yellen, says he's done a great job, but she changed her tune over the weekend.
Job, but he's enabled everything that the Biden administration has wanted to do. I mean, he couldn't have done anymore. If they don't, after all he's done, if they don't, that's ingratitude. I mean, he's ruined his reputation among among conservatives that would like him to take the punch bowl away.
He did what needed to be done during the pandemic. But yes, I think if given his druthers, maybe if he wasn't up for this position.